this was such a strong rally and it reversed down abruptly. Here's a disappointment bar, but the bulls have bought up here and never had a chance to get out break even. So some of those bulls waited for another bottom attempt, maybe here, and bought more, hoping the market would come back up here, allowing them to get out break even on these buys and with a profit on the lower buys. And I still think that's where we're headed, even though it's higher up than what most people are saying, most people on TV. The bears are hoping we have a head and shoulders top, left shoulder head and right shoulder. And the bulls are hoping we have a double bottom. They want to break above the neckline and a measurement up. The bears want to break below the neckline of the head and shoulders top and a measurement down. We've been sideways for, seems like a year and a half, but I think it's about 15 months. This is the daily chart. We keep breaking bull trend lines. I had a bull trend line drawn across here, broke a little bit above it. A bull trend line here, broke above it. A bull trend line here, broke above it. And now we have another bull trend line here, breaking above it. We're breakout mode. You can call it a triangle. Bulls want to get up to a new all-time high. I don't know, maybe there's a 20% chance we just go straight up to a new high. And if we do, I think there'll be sellers up there that will form some kind of a double top and come back to the middle of the range. I think most likely we're going to go up a little bit more, maybe to the August high over the next few months. And I think we're going to break below the October low and get down to between around 3,000, maybe 3,200, maybe 2,800. Okay, broke above yesterday's high. This is a small pullback bull trend. We had a sell-off here, but it's still a lot of bars without much of a pullback. So I would call it a buy climax day, and 75% chance we're going to have at least a couple hours of sideways to down trading today. So it could start on the open. It typically starts by the end of the second hour. So sometime in the first 24 bars or so, we should get a couple hours of sideways to down trading. 50% of the time, we get some follow through buying on the open. We have a buy climax day. What happened here? Well, normally when you have a pretty strong bull trend day, the bulls take some profits at the end of the day, so you get a profit-taking sell-off. And the bears know that, so the bears short somewhere late in the day, betting that the market will come down, maybe down here, maybe down here. But if you don't get the sell-off, the bears have to buy back their shorts. So this is a short covering rally. How do I know it's bears buying back shorts and not bulls buying to get long? Well, the bulls had 78 bars to get long. They're already long. There are not too many bulls who are not long by the end of the day. And so, this is not a bunch of bulls buying, saying, oh my gosh, I'm missing a great bull trend. So if it's not bulls buying, who is it? It's bears buying. They're seeing a lot of pullbacks. They're seeing a big sell-off here. They're seeing a small pullback bull trend that has gone on for a long time. We're near the top of the past 2 days. So they were expecting at least a tradable reversal, maybe down to the 60-minute moving average, maybe to this breakout point, and it didn't come. So the bears who were accumulating shorts, building a short position, panicked at the end of the day. Trading is fairly light. I guess on Easter week, I don't know, but it's fairly light. Remember, I said there's a 50% chance yesterday's bull trend will continue on the open, right? So 50% chance we could get a rally for 5 or 10 bars on the open, but 75% chance we're going to go sideways to down for a couple of hours. 25% chance today will be a second consecutive small pullback bull trend day that lasts pretty much all day. What do you do here? Is that good for the bulls? No. Is it good for the bears? No. It's a failed breakout above yesterday's high, but we closed above the midpoint of the bar. So for me, it's a reversal bar. We sold off, we rallied, and the bulls own the bar. I always look at the close of the bar. If it's in the upper half, I say the bulls own the bar, even if it's a bear body. I think the bulls did more than the bears. And if it closes below the midpoint, I think the bears owning the bar. And I'll also look at breakouts. We had a breakout here above that, and it closed above that. And it closed quite a bit above that and above the 60-minute moving average. Speaking about that, the market has been paying a lot of attention to the 60-minute average for 3 days. Here, 60-minute moving average, resistance, 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 resistance. Right? But the day before, 60-minute moving average, we sold down to support, 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 support. So it's been paying a lot of attention to the 60-minute moving average for the past few days, and we broke above it yesterday. 60-minute chart, a really strong rally, and we were above the moving average for more than 20 bars here, and we could finally get down to it, and the bulls are deciding, are they going to buy it and get a resumption of the bull trend, or are we going to fail and get a lower high major trend reversal and another leg down? It's a bull trend. It's more likely that we're going to go higher. And we're getting a lot of bull bars here. We're not breaking strongly to the upside yet, but it's still a lot of bull bars. The bears will probably need to get bars like this today or tomorrow if they're going to get the reversal down. So chances are we're going to go higher. Monthly chart, we had a buy signal last month. We had a wedge pullback to a 50% retracement of this rally. A very good buy signal bar, very good bull bar here and here and here and here, and then again last month. So good buying pressure, but we're alternating bear, bull, bear, bull, bear, bull, bear, couple bears, couple bulls. But we've been alternating for over a year and a half now. So is this month going to be a bear bar after last month's bull bar? I don't know. We got 4 very good looking bull bars here since that October low. So I suspect we're going to get up to the next major resistance on the monthly chart, which is up there, the August high. I still think we're going down to a measured move from 4,000, which is right here, to the all-time high. We've been oscillating around 4,000 for 15 months, and so I think we'll get down to a measured move. I think I have it on the weekly chart. Yeah. Here's 4,000. We gapped up above it on the daily, weekly, and monthly charts, and we've been oscillating around it. So it's clearly a very important price. This is an important price. And when you have 2 important prices, they often generate a third one, and that would be a measured move down from the all-time high to 4,000. Takes us here, 3,200, below here. I think there's better than a 50-50 chance we're going down here. Sideways for 15 months, it's hard to say that anything is much more than 50%. So to say it's a 60% chance we're going up or a 60% chance we're going down, you can't say that. The market would not be doing this if there was a 60% chance of it going up or down. But I think it's better than 50-50 that we're going down here. Right now, this is reminds me of yesterday. On the open, when things are really not clear, I wait for a couple consecutive bull or bear bars, and I like to see a couple consecutive bear bars with at least one being big and closing near its low. And for the bulls, I want to see a couple consecutive bull bars with at least one big closing near its high. So we had a bear bar on the open, very far below the moving average. Nobody wants to sell that far down unless the bear bars are very strong. And that tail, that's not good. And then we had a pair of bull bars, at least one being big, closing near its high. So it's buy the close, buy above it, stop below it. We held above it. In fact, we held above it all day. A weak rally. The bears got a pair of good bear bars closing near their lows. The start of a sell to close bear trend, but it reversed up one tick below this low. So you got to be wondering, is it a double bottom, higher, low, major trend reversal? Not a good buy here or here or here, and then we broke out. So bulls would either buy here or here. At this point, we have consecutive big bull bars closing near their highs, closing above the moving average. with the second body completely above the moving average and also closing far above the neckline of this double bottom. So it was likely that this was going to lead to a measured move up. Measured move up either from the double bottom and the neckline, or measured move up from the low of the day to the high of the day. And it went above both measured moves. Here, failed breakout above yesterday's high, a micro double top. We went down on one and then up on one and two and then down on two, but tails on the bottom of one and two, not too far above the moving average. Yeah, I think we're going down to the moving average, which is at the Globex low, but I'm not sure that we're going down here. This was an area of agreement. So if you get a reversal, the market may try to come back to this area of agreement. 60-minute moving average has been really important for several days now. So we may come all the way back down here. We have a spike, pause, and channel. So the start of the channel here or here, that's a magnet. 60-minute moving average is a magnet. But it's still not yet a good stop entry sell. There's still a 50% chance we'll get follow through buying on the open. But with the two bear bars, traders would need a really strong bar 3, a bullish bar 3 to buy. So we should come down to the moving average at a minimum in the next few bars, especially since the Globex low is there. Globex range is small. When you have a small Globex range, there's an increased chance that you break out of the range, and there's also an increased chance that you break out of both the bottom and top of the range. So we may go below the low of the Globex range and then above the top of the Globex range. But right now, there's at least a 90% chance we're going to go either above that or below this. And right now, it looks like we're going below that, especially since the Globex low is around this moving average, which is another magnet. Can you be short here? I think it's probably not worth it. 2 is not a good enough sell signal bar. What happens if 3 is a bear bar closing on or near its low? It would be a sell to close swing sell signal, but it's still a small pullback bull trend. They bought the moving average here and here. The probability is not high. So if 3 closes near its low and you sell one tick below 3, I would trade small and then look to add on if it keeps going down. It's a small pullback bull trend, so it's a lower, and it's not a good sell signal bar, 1 or 2. So, I would only sell if it's perfect, and personally, I'm not going to sell. And what about buying a high 1 above 3 if it's a bull bar? Well, look at this. A bull flag here and went up, a bull flag here and went up, but both pulled back to the moving average. We're not quite to the moving average, and I think we're probably going to get there. We can get there by going sideways or down. Also, 1 and 2 are bear bars, so that will further reduce the number of bulls willing to buy above 3. So I would not buy above 3, and I'm not planning to sell below 3. Small pullback bull trend right above the moving average. I only want to sell if the setup is perfect, and this is not perfect. It's a high 1 bull flag in a small pullback bull trend, but the moving average is a magnet, reducing the probability that we're going to go up. And 1 and 2 are bear bars, so we had some early selling. So this is not a stop order market. It's more of a limit order market. We've had a lot of small days lately, and you can see on the daily chart, in the past 10 days, most of them were fairly small. A lot of limit order trading. If it's limit order trading, can you buy the too low? I would not, because we're probably going to get down to the moving average. And can you sell the 3 high? Probably, but it's tricky. Where do you put your stop? Do you put it above 1? Well, there are probably more sellers above 1. So you only sell the 3 high if you can sell more higher. And if you can handle something like this, here we had a bunch of bear bars. Some bears sold this high, some placed limit orders to sell more higher. But at some point, you have to decide the market is going up instead of down. This is a bear trap. The bears were hoping it was going to be the start of a bear trend, a spike, bounce, and bear channel all day. Instead, it was a test of this low, and one tick below it and reversed up. And here's where it became clear that it was a trap. This was potentially a bear flag. We broke above it, and then it became much more clear once we had that. Is this a sell climax or a bear trap? Well, all sell climaxes are bear traps. All bear traps are sell climaxes. So they're just two different names for the same thing. And if it's brief, usually 1, 2, or 3 bars, I call it a bear trap. And if it's big, like 4, 5, 6, 7 bars, 10 bars, I call it a sell climax. So which is this, a sell climax or a bear trap? Since it was simply a test of that, I would call it a bear trap. Also, on the day, we had not yet had a clear swing set up at that point. So this was potentially the start of a sell swing down, and it failed. So it trapped bears into a bad short. On the weekly chart, 3 consecutive bull bars. Last week was a bear doji. The bears were hoping it's a reversal down from the bear trend line. But with the 3 bull bars having good bodies, if we do go below last week's low, there probably are buyers not far below. What about the head and shoulder stop? Left shoulder, head, right shoulder. It's not a good sell signal bar, so probably more buyers than sellers below last week's low. But if you get a pair of bear bars with at least one closing near its low, even with the 3 bull bars, you'll get bears starting to sell, betting that we've begun a bear trend. A weak high 1 buy signal, probably sellers above 3 and sellers above 1. Most traders should do nothing here. Wait to see what we get. If 4 and 5 look like this, it's a buy. But if they don't, it's probably better to wait. Probably more sellers than buyers above 3 since it's a weak buy signal. But as I said, when you have a small pullback bull trend like yesterday, 50% of the time, you're going to get follow through buying for 5 bars, 10 bars, sometimes an hour and a half. Here's today, here's yesterday. Yesterday's a buy climax. 50% of the time, you get follow through buying. And 25% of the time, you get a second consecutive big bull day like that. Yesterday's a sell climax day. Very strong buying, but by the end of the second hour, sideways. So you're looking for 75% of the time, you're going to get sideways to down for a couple hours, starting by the end of the second hour. Yesterday, really strong buying for the first couple of hours here, and then sideways. Yesterday, a little bit of follow through buying, and then sideways to down the rest of the day. Yesterday, very strong small pullback bull trend day. Today, follow through buying, and then sideways here for about 22 bars, not quite 2 hours before the bull trend resumed. Not a good looking sell for the bears. They have a tail on the top of 4, but 4 is a bull body. The odds are we're going down to the moving average because 3 things. Yesterday is climactic, and 2, we have bear bars and we're just above the moving average, and the moving average is a magnet, especially on the open. And then 3, the moving average is right around the Goldbeck's low. So chances are sellers above 3, and we're going to get to the moving average at a minimum. Maybe to the bottom of this buy climax, maybe here. Maybe to the bottom of this trading range down here or here. It's even difficult for limit order traders to make money when the bars are small and sideways with big tails. So best choice for most traders, Just patiently wait until things become clear. Like yesterday, you don't sell until that or this. If you did sell this, you get out above the bull bar. And wait, it's not a very good buy despite the double bottom, a lot of big bear bars. But then once you get this or this, you go long and you expect the measure to move up. When you get a breakout, here we broke above the 60-minute moving average. We broke above this high. That high is the neckline of this double bottom. It's also the high of the day. So many different ways to look at measured moves. One is you get a double bottom and you got a neckline here. So measured move up, reached it there. And then a new high of the day. The day's range here is only about half of an average day's range. So maybe the range will double. So maybe you'll get a measured move from here to there. And we broke above that here. And then also when you get a really strong breakout, the market often makes a measured move from the open of the first bar of the breakout to the close of the final bar. So here's a 2-bar breakout. So from the open of this bar to the close of that bar. And look at the high here. It's almost exactly to the tick a measured move based upon the bodies of the breakout. And you get some profit taking. Hit the target, some profit taking. Here's one of the measured move targets, some profit taking. You can see we're going to get down to the moving average. Past 3.5 days sideways, and we're at the top of the range. The bulls are hoping we have a double bottom, a neckline, and we go up for a measured move. And the bears are hoping we'll reverse down from the top of the trading range, at least to the middle of the range, maybe to the bottom of the range. Middle of the range is right around the start of the channel from this spike, pause, and channel. So we may come down this area. The limit order bears who sold the 3 high needed to fall 20 ticks below the 3 high for them to make their 5 points. Okay, the 3 high is at 39.5, so it has to fall to 35.5 plus. It fell exactly to 35.25. Had to fall 5 ticks, 5 points plus 1 tick. So the limit order bears who sold the 3 high placed a limit order to buy 5 points lower. It had to fall 21 ticks to get filled, and the 5 low is exactly 21 ticks below there. So the limit order bears who sold the 3 high bought back their shorts here and went exactly where it had to go to for them to buy back their shorts. That's the high from 2 days ago. Yesterday's high, I'll leave that out. Yesterday's high is exactly at that March high. Is it always in short yet? We're still above the moving average, and the pullback is still small. So it's still always in long, but I would do nothing. Suppose 6 is a bull inside bar closing near its high. Then we have a high 2 with bar 3. But we still only have, so far, 1 bull body in the first 5 bars, and it's a small bull body. And we have 2 magnets right below. So I still would not buy above 6. We should get down to the moving average and the Globex low. 2 magnets around the same price, and we have exhausted bulls from yesterday. This kind of double bottom, higher low, we have a higher low, and we tested it, and we formed a double bottom, higher low, and we got the major trend reversal. It's a pretty common pattern. So we're far below the moving average. We got a big sell-off and then a reversal up. We have a higher low, a bear body, and then we got a second, we got a test of it. So it's a double bottom, higher low, and it's a major trend reversal. We broke above a bear trend line, and this is not a very good buy. It's only 3 bear bars. So, but then this is a better buy. The pattern has more bars, plus it's a double bottom, higher low. Another version, small double bottom. We have a rally, and then a double bottom, and then the start of a bull trend. And sometimes it's a bigger pattern. So we have a reversal, and we formed a double bottom, and then we rally. So sometimes you get a double bottom that is a higher low. Here it's a double bottom, now a triple bottom before the market actually reversed. Sometimes it's a lot of bars. We got a strong reversal up, a trading range, and we formed a double bottom before we finally got a bull trend. Another example, it's a double bottom and then it became a triple bottom before the bull trend resumed. We never fell below that low. Another example. And the reason I have a lot of examples is because it's a common pattern. Slightly lower low, we tried to get a double bottom here, and then we formed a lower low double bottom here, and then the bull trend. So lots of copies. Here, a double bottom bull flag, and resumed up. So this is a common pattern. And when you have double bottoms, 2/3 of the time, the second leg down is weak, like a wedge, but 1/3 of the time, it's climactic like that, and then you reverse up sharply. So this is an example of the second leg of the double bottom being a sell climax. 4 of the first 5 bars, bear bodies, not good for the bulls. Remember, we should get at least to 1 tick below the moving average, and we're so close to the Globex low, we should get down to the Globex low. Not a good low one sell signal, bar 4, but chances are we're going at least a little lower. Bears trying to get a breakout. A bear breakout is a bear bar closing near its low and closing below the low of the prior bar, and preferably closing below some other low like this. Here's a bull breakout. It's a bull bar closing above the high of the prior bar and closing near its high. That's the minimum for a bull breakout. And then hopefully you're breaking above something else. Here we broke above the high of the past 37 bars. A lot of bars, good. We broke above the top of a trading range, good. We broke above the 60-minute moving average, good. We closed far above all of that, good. The bar afterwards had a bull body, good. All of those things increase the probability that we're going higher. And when you see this, with everything good, 70% chance you're going to go up for some kind of a measured move. I know you say, well, Al, if I buy here, my stop is down here, I don't want to risk that much. Fine, just trade small. So if you normally trade 1 E-mini, just buy maybe 2 micro E-minis and buy 2 more here and 2 more here and 2 more here or here. You add it to it as it goes your way. Are we always in short yet? We probably are. We have 5 bear bars in the first 6 bars, but it's not strongly short, and we may end up going sideways instead of down. Is it sell to close? No, I think it's better just to wait. And can you buy above 7 if it's a bull bar? Another pullback to the moving average like this or that. With 5 of the first 6 bars, bear bars, I would not buy the first reversal up to 7. So, not good to buy, not good to sell, better to wait. Some bears are short from the 3 high, taking a chance that we've begun to move down to the 60-minute moving average. But I think it's really not strongly trending. And if a bear trend is not a strong bear trend, traders prefer to sell pullbacks instead of selling closes. So 1, 2, and 3 bear bars, traders were not eager to sell below 1, 2, or 3, but they were willing to sell bounces like the 3 high. Here, the trend is strong, and traders are willing to buy at the high. But when the trend starts to become weaker, you'll have fewer bulls buying at a new high. In fact, you'll get bears selling with limit orders at the high, looking for scalps, and bulls prefer to buy pullbacks, so they're not buying at the high. And then when it gets to the high, they take profits. So a weaker bull trend, bulls buy pullbacks and take partial or full profits at a new high. And if the bears look and see that it's a profitable strategy to sell at the high and sell 5 points higher. That's what they do. They'll place a limit order to sell at that high. They'll place a limit order to sell at that high, and they place a limit order to sell at this high, except this late in the day, I'm not going to be trading with limit orders, because of the risk of this. You can get very sharp moves at the end of the day and no time to get out. Theoretically, 67, all right, you had some bears who sold with the limit order at the 67 high, the 77 high, and they sold more higher, and they waited for today, believing that today would dip below that 67 high, and they could get out break even on that short here from yesterday, and then with a profit on the shorts 5 or 10 points above. And we should fall below that 67 high. Those theoretical bears should make money. It was a reasonable thing to do, and reasonable, theoretically reasonable, as I said. There's no way I'm selling with a limit order and a small pullback bull trend in the final half hour because of the risk of that. But, if you can use wide stops and scale in, theoretically it's reasonable. So theoretically, there are bears who sold that high, sold more 5 points higher, and they have limit orders to buy back their shorts here. Bulls trying to create a credible high 2 at the moving average, but we have 5 bear bars in the first 6 bars. That will reduce the number of bulls willing to buy above 7. A lot of the bulls will wait to see if we get 2 bull bars, 7 and 8, and then buy. Looks like a trading range open. Every bar is overlapping every other bar. Every bar has a conspicuous tail. The bodies are small. Stop entry traders have not made any money in the first 7 bars. The only people who have made money are limit order traders, traders who sold the close of 1, traders who sold the high of 3. A high 2 with bar 3 and a bull bar at the moving average, but a big tail on top, a tight bear channel, a lot of bear bars, and magnets below. We should fall below the 67 high, and we should fall below the Globex low. Why should we fall below the 67 high? If the trend is really strong, you're not going to fall below the breakout point. Really strong bull trend, somebody placing a limit order to buy a pullback to that high, it's a low probability bet because the trend is so strong. Here, the trend is not as strong, and we have a lot of trading range trading here. When the market has trading range trading, limit order traders tend to get rewarded. So the bears who sold that 67 high should get rewarded. So we should dip below that high by at least 1 tick for those bears to get out break even on their sell that took place here. And if they sold more higher, they'll make a profit on the higher sell. Now, given that 7 is a bad high 2 bull flag, can you sell the 7 high? I said you could sell the 3 high with the 3 bear bars and room to the moving average, but we're already at the moving average, and now we have a bull bar 7. So I think there'll be fewer bears selling the 7 high. So best choice right here, wait. Not a good buy, not a good sell. We should dip below the 67 high, but we may bounce up to the high of the day before we get there. No, better to wait. Consecutive bull bars, 1 closing on its high, but not especially big. For the bears, it's a low 1 in a bear trend, a lower high double top, but 2 bull bars at the moving average. Not a good buy, not a good sell. I still think we're going down to the Globex low and the 67 high. This is trading range behavior, and in a trading range, you normally fall below breakout points, so we should fall below that high. Can you buy with a limit order at that high? No, we'll probably get at least to the bottom of the most recent leg up here, and I suspect we'll come back here. The market was here for several hours yesterday, so the market thinks of it as a fair price. We're getting late in the first hour. Traders are starting to think about what the 60-minute bar is going to look like. The bears want a double top here at the top of this trading range, and they want a reversal down. The bulls want a breakout. They had an attempt at a breakout here, close above that. We have a double bottom neckline, but we're reversing down, so it looks like the breakout above that is failing. So we may come down to the middle of the range, maybe to the bottom of the range. Bulls are trying to get a bull follow-through bar. We still have 15 minutes left, and it's possible that this 60-minute bar could have a bull body. Here's the open of the day. So for the first hour to have a bull body, bar 12 has to close above the open of the day. Most traders will just wait. Not good stop entry buy above 8, not good stop entry sell below 8, and the bars are so small and the range is so small, it's really not very good for limit order traders. Right now, theoretically, 8 is a bad sell, so bulls might buy that 8 low. I would not, because I think we're going below the 67 high, which means below the Globex low. So I would not buy the 8 low. And as I said, I did not sell the 7 high. Better to wait. Outside down 9, lower high double top 4, or simply a low 1 and a bear trend. And we're going lower. We're going below that 67 high. Can you short it? We're still at the moving average. Right? We've been above the moving average since bar 37 yesterday. So you don't want to be selling too low unless the bear trend is strong. So selling below 9 is selling at the bottom of what the bears hope is a bear trend. So not good. Remember I said I would not buy the first reversal of 7. But if we go sideways here and form a double bottom, maybe 6 and 10, and then get a good bull bar on 10, traders will buy that, betting that the market will rally into the end of the hour and close above the open of the hour. Right now, most likely we're going below the 67 high. I said by 1 tick. It could be by 20 points, but the minimum is that we go 1 tick below it. And you buy the close of 9. In a trading range, I often buy the close of a bear bar near the bottom of the range. And I'll often sell the close of a bull bar near the top of the range. But the range is so tight. Also, I think we're going below the 67 high. So why should I buy the close of 9 when I believe we're going at least a little bit lower? Theoretically, there are bears with buy orders at the 67 high, and that's still 1 tick below. Smart bulls know that. So smart bulls have limit orders to buy at the 67 high and 1 tick higher. They want those bears to be trapped, and those bears would then have to buy back the shorts, just like they were trapped at the end of yesterday. But chances are we're going below that 67 high. And chances are the bulls who are buying here, trying to create a gap between the 67 high and the 10 low, chances are it's going to fall a little bit lower. Some of those bulls will buy at and above the 67 high and put a stop just a tick or two below. So they don't have to risk much. They're trying to have a breakout test. They're trying to have the 10 low be a test of the 67 high, and then they're trying to get a reversal up, a high 3, a wedge, 1, 2, and 3. Whenever your risk is small, so if you bought 1 tick above the 67 high and you put a stop to exit 1 tick below the 67 high, you're risking 2 ticks. Whenever you take a trade with very little risk, you have very little probability. So if you have a low risk of making a big reward, if you spend $1 to buy a lottery ticket, you have very little risk. You're risking $1, and you can win $1 million. So big reward. Anytime you have really great risk reward, you have very low probability. You're probably going to lose. One of the things that I find annoying on television is You often hear some traders say, "Oh, I like this trade because the risk reward is good." But that's a stupid thing to say, because if I go short here and put a stop here and bet that the market's going to fall 4,000 points, I'm risking 10 points to make 4,000 points. The risk reward is good. Why am I not taking the trade? Because it's not going to happen. The probability is so small, it's not going to happen. So you cannot just talk about good risk reward. You always have to talk about probability. So whenever someone on television says, "I like the risk reward," what they're saying is the probability is it's a losing trade. You're probably not going to get your reward. A wedge bull flag at the moving average, but a bear body. So, not a good buy. Plus, we have magnets below. Since the bulls have a credible wedge bull flag at the moving average, and we're probably going to go below the 10 low, we may fall for a measured move down. We may get a breakout below that 10 low. Remember, the bulls are trying to get the hour to have a bull body. So they're trying to get bar 12 to close above the open. But chances are they're not going to be successful. And no surprise, if we break below this bull flag, where does the measured move take us? Down to the 60-minute moving average, which has been the most important price for the past several days. Can you sell on a stop, one tick below 10, and then place a limit order down here? As I said, in strong bear trends, selling at the low is a good thing. In weak bear trends, this is a small pullback bear trend, but it's mostly sideways here and here. The probability is less, so it's really not a very good short below 10. Better to wait to see what the breakout looks like and then go short if the breakout is strong. Some bulls bought the 27 high, others waited to see the breakout and the follow through, and then they bought. And if they did, they still made 20 points by the end of the day. Bulls hoping for a sudden rush, a big bull bar closing near its high and closing above 1. They're hoping to get that on 11 or 12. They probably are not going to get it, but that's what they're hoping for. This is 11, and bar 12 is the final bar of the hour. The market often does something at the end of the hour to change the appearance of the 60-minute bar. And if you look at a 1-minute chart, you'll notice every fifth bar has a higher probability of being a big trend bar up or down because it affects the appearance of the 5-minute chart. Small pullback bear trend, can you sell the 10 high? Betting that will break below 10 and fall for a measured move. I would not. Right now we have a wedge bull flag, a high 3, 1, 2, 3, with a bull body. Hard to see, but there's a small bull body in a bull trend, and it's about a 50% pullback of that. So I would not sell the 10 high. Can you buy the 11 high, betting that this is a resumption of yesterday's bull trend? I would wait, betting that this is a resumption of yesterday's bull trend. I would wait. You can see bulls trying to turn the 60-minute bar into a bull body. If they can't do that, the next best thing is they try to get the bar to close above the midpoint. This is the midpoint of the hour. Remember what I said on bar 1? If you close above the midpoint, it's slightly more bullish, even if it has a bear body. And the bulls, if they cannot get the hour to close above the open of the hour, at a minimum, they like it to close above the midpoint. So the market may be, well, it's deciding, is it going to close around the midpoint or around the high? It's probably not going to be closing near the low. And what happens if the market closes around the midpoint of the hour? Can you sell below 12? Can you buy above 12? Well, you're in the middle of a trading range, and usually better not to enter with stops in the middle of a trading range. So again, still better to wait. What happens if 12 closes near its high? Then we'll have 3 consecutive bull bars, 2 of them closing near their highs. So if 12 suddenly becomes a big bull bar in the final minute, closing near its high, it would be a buy the close bar. Buy the close bulls need this to be as bullish as possible, and that means they want 12 to be as big as possible. Now, what do you do? Do you buy above 12? You can do it for a swing, or you could wait for the breakout above the high of the day. Can you sell the close betting double top 4? I would not. I think we have consecutive bull bars with decent sized bodies closing near their highs, and the second body is completely above the moving average. The bodies are not especially big. We're still in a trading range, but that's bullish enough for, I think, traders not to be selling the close of 12. Can you buy one tick above 12? I don't think there's a rush. We still might get a double top 4, and this could be the opposite of yesterday. Yesterday we had a higher low double bottom, and the second leg down was a sell climax. Here we have a lower high. The bears want a lower high double top, with the second leg up being a buy climax. So they're trying to get the opposite of what we had yesterday. Probably back to always in long, but not strong enough yet to buy the close. 15-minute chart. We have an outside up bar above the Globex low. Remember, we had a small Globex range, so better than a 90% chance we either break above the top or below the bottom. The bulls are hoping we now have a double bottom. We break above the neckline and go above the Globex high. And bears are hoping that we still get below this. Can you short below 13 if it's a bear bar closing near its low? Double top 4, the opposite of what we had yesterday. The double bottom, and the second leg was a sell climax. And here we have a double top, and the second leg is a buy climax. I think so far it's a trading range, and we're in the top half, and that's usually a bad location for buying with stops. So I still think it's better to wait. And selling below 13, actually, it's probably better to wait. You're selling with a stop in the middle of a trading range. Buying above 12, you're buying with a stop at the top of a trading range. And both of those things are low probability. Do I still think we're going to drop below the 67 high? Yes. But if we break strongly above the high of the day, then I'll change my mind. Trend traders want the market to go in one direction for a lot of bars. Bulls want a series of bull bars, and a series of bars going above the high of the prior bar. Bears want a series of bear bars, with a lot of the bars going below the low of the prior bar. That's not what we have. We have a trading range market right now. And it could be a bull trend. 10 could be the low of the day. Could be a bear trend. 1 could be the high of the day. The market is still deciding. So better to wait. If you're determined to do something, you could buy above 12 and take a chance. But I would not. You could sell below 13 for the double top. But I would not. We're mostly above the moving average. So even though I think we're going down here and maybe down here, the math is just not all that good for stop entry traders yet. Now, We have a wedge bull flag, 3, 9, 3, 7, and 10. What happens if we break below it? We go one tick below 10. Then if we close below 10, you have to be thinking about a measure move down to the 60-minute moving average. Can you sell on a stop one tick below 10? Whenever you break below an obvious location for a stop, 50% of the time you'll get a swing down, a measure move. 50% of the time there'll be buyers below and you'll reverse up. So it's okay for a swing trader to sell below 10, initial stop above 12, and hope that this is sort of a trend, but 50% chance there'll be more buyers than sellers below 10. So if you do sell below that, you have to make really quick decisions. Higher probability, wait to see if we close below 10, and if the breakout bar closes near its low, and then sell at that point. There's a hoping that this is a reversal down from a double top, and we keep going down. Bulls are hoping 13 is just a pullback from 11, 12. I still think more likely we're going below 67, and that means we'll probably come down here. Measured move, 60-minute moving average in the middle or the bottom of this channel or trading range. There's getting the breakout. Will there be follow through selling and a close far below 10 and a measured move down? Or will we reverse up? And this is a failed breakout below the bull flag. We got below the Globex low. We got below 10. We got below the 67 high. The bears want a measured move down. Incredible. It's okay to be short here with the probability being lower than you want. It's basically 50-50. If you are short, I'd be trading small and then add to it if it keeps going down. And if instead it reverses up, you will not lose much. These are all PowerPoints containing slides in my encyclopedia. Every day I categorize different things that took place in the day, and I put them in these folders. Bull flag that failed. Bulls trying to get a wedge bull flag. Instead, we got a big bear bar closing near its low, and it led to more than a measured move down. Wedge bull flag, double bottom. Instead, we broke to the downside. Bad follow through, but then we got a low 2 here. So if you did sell on a stop below that, you could get out here and then sell again here, a low 2 at the moving average with the bear bar closing near its low. I call this a wedge bull flag, so it's a small wedge. Here we have a wedge bottom. We broke below it, but then we reverse up. Here we have a wedge bull flag. We broke below it, and we continue down for a measured move. So that's what we're deciding right now. Is the breakout below the wedge going to fail, or is it going to continue down for a measured move? The wedge bottom and a breakout did not get very far, and it failed. It failed to go down for a measured move. 14 close above 10 low, not good for the bears. But 14 close in the middle of the bar with a pretty big bear body. So not a good buy for the bulls. So you have to wait for more information. We may have to go sideways for a few bars and form either a micro double bottom and reverse up, or a low 2 bear flag and continue down. Right now I think we're always in short, but it's not quite strong enough for sell to close. The bears who did sell one tick below 10, their initial stop is up here, or the size of a scalp above 14, and that is up here, which is above that. So the bears will get out above here. The bulls know that, so they'll try to get at least one tick above that. Trading range trading. We broke out above 9, reverse down. Broke out below 10, reverse up. No rush to do anything. Limit order trading. They buy the prior low. They buy the 1 low, the 3 low, the 6 low, the 10 low, and they sell above any prior high, above 9. Then they look to scalp out with 5 points. Since the bears get out above 13, can you sell the market and sell above 15? I think it's okay. And can you buy above 15? If it's a bull bar closing near its high, you can buy back shorts. I personally would not get long. I still think we're going to go down here, but we may have to go sideways for a few bars first. We may have to do, let me see. I've already deleted it, but we may have to go, we may have to here. I've already deleted I closed off that file. Well, a lot of times you'll break below a support level and bounce for a few bars and form a low 2 below the moving average before continuing down. Bears trying to turn trading range trading into trend trading. So they want bear bars. They want consecutive bear bars. They want bear bars closing near their lows. They want bear bars closing below prior lows. 14 did not close below 10. On the 15-minute chart, we have an 00, outside up and then outside down, breakout mode. So theoretically, it's another sell signal below 15. Can you buy above 15? Nope. Can you sell the market and put a stop above 13? Yes. Can you sell above 16? Probably. But not strongly bearish. And therefore, we may have to go sideways here for several bars. More and more bears are selling. More and more bulls are selling out of longs. So it's becoming sell the market, sell for any reason. If you sell, I would trade small. Can you buy above 16? With the 3 bear bars, you would need a pretty dramatic bull bar 16 to attract many buyers. Bears, I'd get out of a bull bar closing near its high. When I was, if you get a small bull doji bar, do you get out above 16? You can always sell again below the next bear bar. Remember I said we may test the bottom of the most recent leg up, the 78 low. So some bears are buying back shorts here. Remember I said the Globex range was especially small. And when it's very small like that, there's an increased chance you break out of the bottom and the top. So this could be the start of a trend up to above the Globex high. The bigger the body on 16, the more bulls will buy with a stop above its high. And for the bears, I would get out above any bull bar at this point. A lot of trading range trading. You can always sell again if you get out. You can always sell again below a low 1 bear bar. Bulls are hoping this is a failed breakout below a wedge, and that will put in the low of the day. It's important to see that the stop order bulls, the stop order bears have sold below 10. It had to fall 22 ticks for them to make money. The 10 low is at 41.33, and this is 28.75. So the stop order bears have sold 1 tick below 10, have not even made 5 points, and they're seeing it bounce, and they're buying back their shorts in a panic. So I get out of shorts here. You can always sell again if 17 or 18 is a bear bar closing near its low. And for the bulls, I think it's not a great buy. It's a possible low of the day. But I'd like to see a couple bull bars, and I'd like to see it break back above the moving average before buying. Strong bear trends do not do this. A strong bear trend, the bears would have made money selling with a stop below 10. They did not. Instead, the bulls have bought the 10 low. They tried to buy more 5 points lower, unable. It's back above the 10 low. And some of them will now exit. So you'll get some bulls selling here, even though we have a buy signal bar. Some of the bulls 10 would be so disappointed by how far we fell below 10 that they'll sell out of their longs. Bears are trying to get a low 1 or low 2. They're trying to keep it below the moving average. Best choice here, flat. Second best choice, long, but look to sell if we get a decent bear bar 17 or 18. This is really not very good trading for stop entry traders. Bull trend, bull flag, strong breakout below. The bull flag failed. A wedge bottom, strong breakout below, went down for measured move. Strong breakout below. Big bear bars closing on their lows. Today, I mentioned 14 did not close below 10. 15 did, but it did not close below 14, and then we got a reversal 16. We're in a bear channel. I think we're still always in short. I think it's better to exit shorts here above 16, but I think it's more likely that we'll get a low 2 or low 1 or a low 2 in the next few bars than it is that we'll keep reversing up. But if we get a big bull bar, 17 closing on its high, closing back above the moving average, that would indicate that this is probably going to be the start of a swing up. So can 17 close on its high? Can it close above the moving average? Can it close far above the moving average and have a big body? The more of those things we get, the more bulls will be willing to buy. On the other hand, can the bears prevent that? And if they're able to prevent it, bulls are not going to buy, and bears will start looking to sell again. They're hoping 17 is a bear bar closing near its low, but 16 is a big enough surprise. We'll probably get at least a small second leg sideways to up. So there may be more buyers than sellers below 17. So not a good sell below 17, not a good buy above 16. So we'll probably have to go sideways for another couple bars. The bulls have bought above 16, stop below 16. And for the bears, I think 17 is not a good enough sell. What happens if 18 collapses and it's a huge bear bar closing down here? Well, if you're always in short and you exit like above 16, you're looking to sell again. And there are two ways to do it. One is you wait for a bear bar closing below its midpoint or closing near its low, and you sell with a stop. If you don't get that and instead you collapse, you sell below the bottom of the bear trend. So you either sell below a good sell signal bar in here or on a stop one tick below 16. 15-minute chart, a pullback to the moving average, and a high 2. I'm not trading the 15-minute chart, so I'm not going to be paying attention to that. When you have bad follow-through, you have confusion, and confusion increases the chances of a lot of trading range trading. And we've been selling off for 17 bars, but not strongly bearish. And therefore you have to wonder, is this a bear leg and what will become a trading range? 60-minute moving average, magnet below. I still think we're going to get there today, but not a very good sell below 17. I would not take it. I would wait to see if we get a micro double top, maybe 17, 19. And if you get a low 2 with a decent sell signal bar on 19, then think about selling that. Low 2 bear flag, low 1, try to reverse up and then reverse down. Here a low 1, trying to reverse up and then low 2. Actually, it's a low 2 here also, low 1, low 2. This is more like today. A bear breakout and a strong reversal up, strong enough so you expect at least a small second leg up, and bears will look to sell a low 2. And so low 1, low 2, and they want a bear bar closing near its low. So we may get something like this over the next few bars. And the bulls want an upside breakout. Bulls are hoping we break far above the moving average and above the 17 high and go for a measured move up. And the bears are hoping this breakout attempt fails. They want a low 2 short below 19. They want 19 to be a bear bar closing near its low for the sell signal. Can you buy the 19 low, betting that the low 2 will be a trap and that we're actually in a trading range instead of a bear trend? I would not. Can you sell the 19 low, 1 tick below 19, if it looks like 17, a small bear body? That lowers the probability. The more it closes on its low, the bigger the body, the more likely we're going to go lower. And for the bulls, they need a breakout. They need a close above the high of the prior bar, 18. They need a close above 17. They need a close above the moving average. And they need a close far above all of that. So the more of those bullish things they get, the more likely 16 is the start of a swing up for 20 points. 20 points is a lot of points. So you don't have to buy yet. You can buy. At this point, if you are long, I'd get out below 18, maybe 2 or 3 ticks below 18. And for the bears to sell, I would want a good-looking bear bar, 19. What happens if it's a small bull bar? What do? You wait. Right now, we're still on the buy above 16. We're on the buy above 17, but it's not attracting many buyers. Remember, though, the minimum that the bulls want is a bull bar closing above the high of 18, the breakout point, the high of 17, and above the moving average. So they want a close above the moving average. Do not get it. So the bears have a low 2, but a bull body. So not a good sell. So right now it's still on the buy above 16. If you want to get long, trade small. If you want higher probability, wait for a strong breakout above the moving average and a strong breakout above the top of the rally, the 19 high. By the close of bar 7, 50% chance we've seen the high or low of the day. By the close of bar 12, 70%. By the close of bar 18, 80% chance either this will be the low for the day or that will be the high. Bears trying to get a low 2. Bulls are failing on their upside reversal, 17, 19, 20. So the bears are going to try to resume down, but they need a decent sell signal bar. They'd like 20 to close on or near its low. If it does, it would be a sell, but not all that high probability. You know, a 4-bar tight trading range in a weak bear trend. So today's probably not going to be much of a trend day. It's probably going to be a trading range day. And a trading range day typically has legs in both directions. It typically has legs lasting an hour or two in both directions. So not a good buy, not a good sell. Better to wait. Bulls, if they're long above 16, they can get out a few ticks below 18. They can get out 1 tick below 16. And for the bears, I would wait. I would not sell below 20. I would not sell below 18. I'd not sell below 16. Why? Because there probably are a lot of buyers at the 20 low, at the 18 low, and even at the 16 low. So it looks like it's becoming more bullish. We're starting to get more bull bars. And what sometimes happens is you get a series of pretty small bull bars. And once you've had 4 or 5 of them, traders conclude the market's going up. and all of a sudden they buy and you get an upside breakout. This kind of thing, 2, 3, 4 bull bars, 5 bull bars, and at some point the bears give up and you get an upside breakout. Here, micro channel, that low at this low, these lows, every low is at or above the low of the prior bar, and you get 3 bull bars, 4 bull bars, and at some point the bears give up and everybody buys. So buying pressure, a lot of bull bars, and trending higher lows, every low at or above the low of the prior bar. And if we get something like this, it'll increase the chances of an upside breakout. So some bulls will buy, some will wait for that or that, and then buy, thinking that if we do get 2 consecutive bull bars with decent sized bodies closing near their highs, we're probably going to go up for a swing. Low 2, a bear trend. We have lower lows, we have lower highs, but we have a bull doji, 2 bull bars, and we still have this reversal up 16. So that's not going to attract a lot of sellers. And you can see, it looks like there were more orders to buy the 20 low than sell the 20 low. All right, so limit order bulls bought the 20 low and bears did not sell. So an early small pullback bull trend, and the bulls hope that it lasts for hours like this, and bears hope it's a lower high and that we get another leg down. Bulls at this point, if you're long, I get out below 18 or below 21. Trying to get a breakout. A breakout is a bull bar closing on its high and closing above the high of the prior bar. So they want 21 to close on or near its high and above 20. And if they get that, then you got to be thinking the gap between the close and the 20 high might be a measuring gap. Remember I said there's an increased chance that we will break out of the Globex high because the Globex range is small. So right now, if 21 closes on its high and above 20, that would be the target. And that is around the Globex high. Let me just check. Globex high is around 41.49. This is 41.44, so the Globex high is up here. Can you sell the 20 high betting on a continued bear channel? I would not. Can you buy the 21 close and above 21 if 21 does not close at or above 20? I would not. What happens if 21 only closes a few ticks above 20? Which it did. It closed, looks like, it closed right at the 20 high. We're probably back to always in long, and we're probably, what is it, by the close? Not great by the close. Bulls, I'd get out below 21 at this point. You're buying, betting it's a trend. If it's a trend, it should not go below 21. If you are buying, I would trade small because this is not doing what the bulls want. A good buy signal bar 16, bad entry bar 17. Breakout 21, but close at the 20 high instead of far above the 20 high. So this is not all that strong. Can you short below 22, a wedge lower high? It's a wedge. We have 3 pushes up on 16, down on 18, up on 19 or 20, and then down to the close of 20. Now a third leg up. I'm not going to sell below 22. Don't feel that you're missing anything. This is not strongly trending, and it's not a high probability bet on the bulls. So it's okay to be flat. And can you be short betting on another lower high? I would not, and I also would not sell below 22. I would get out of longs below a bear bar. I'd get out of longs below 21. A lot of bulls will get out of longs on the close of 22 if it does not close above 21. You know, they want a strong breakout, and at the moment, they're not getting it. So they'll get out and then wait to buy again. Okay, breaking out here. Bears giving up, more bulls buying. Bears will try to get a double top 12, and bulls are trying to break above 12. They're hoping that this is the start of a 20-point swing. 20 points above 16 is around up here. By the way, you know, I don't pay attention to Twitter, but it seems to me it's something of a mess. And Musk paid $46 million. If he asked me my opinion, I would tell him do an IPO. Maybe he could raise $20 billion, and I would hire a CEO, maybe a guy like Jack Dorsey. They're trying to get a double top, lower high, major trend reversal. We have a bull trend. We have a bear reversal. So far, minor. And the bears are hoping that 23 or 24 is just a test of 13 and that we reverse down from a double top. So the opposite of yesterday, where we had a double bottom and a major trend reversal on bar 32. And bears are hoping that we get a double top and a reversal down. And bulls are hoping that we break above the high of the day and the Globex high. Remember, I think we're going higher. Weekly chart, we have 3 good-looking bull bars. Monthly chart, last month was a bull bar closing near its high. And on the daily chart, we have 2 bull bars closing near their highs. So all the higher time frames are bullish. Can you sell with a limit order and put a stop 2 or 3 ticks above 12? I would not. This is becoming by the close. If we reverse down, you know, then sell. Well, right now it looks like we're going to go higher. It looks like we're probably going to break above 12 and not reverse down from the double top. Can the bulls get very big bull bars like yesterday, 37, 38? Probably not. But if they get them, that would increase the chances of the market going a lot higher. And the bears are trying to get a double top here. Here, we had a double bottom at the moving average, and then here, moving average, 60-minute moving average was resistance, then a double bottom, and then a double top, and then a double bottom. Bears are trying to get another double top here. I think we're going up here. And I think we're probably going above that, but I think that's where we're trying to go. Broke above 12. Can the bulls close above 12? Can they close far above 12? The more the bar closes on its high, the more bulls will buy above it. Buy the close. It's not only always in long at this point, now it's a buy the close rally. If you do buy, your initial stop is below 21. That was the start of this current leg up. Or you get out below a bear bar, especially a bear bar closing below its midpoint. Or you get out the size of a scalp below any bar, including a bull bar. And for the bears to short, they'll need at least one good bear bar. Some limit order bears are selling the 12 high, betting that we remain in a trading range instead of converting into a bull trend. So you get some bears selling with limit orders here. So they sell this high, they sell that high, they sell more 5 points higher, betting it'll come back down to their first short, and they can get out break even on their first short, and then with a profit on their higher short. Remember I said a small Globex range, increased chance that we break out of the low and above the high. Right now we're back in the middle third. Bears will try to get a double top, or they'll try to stop the rally, and bulls obviously want the rally to continue all day. So far, it's not all that bullish. It's by the close, but the bars are not all that big, and we're at the top of what could be a trading range. So we're not getting a lot of by the close bulls. For the bears, double top 12, but I would not short below 24. The hour opened with bar 13, and the bulls would like the hour to have a bull body, so they want 24 to close above 13. So this is the open of the hour, and the bears would like to get a bear body, so they want 24 to close below that red line. 60-minute chart. We have a resumption of the bull trend, but it's not all that strong. A bear bar, dojis, doji, doji, so not strongly bullish. It looks like a leg in a trading range, which means we may have a hard time getting above this. We may stall and get a leg down at some point in the next 4 or 5 bars, 4 or 5 hours. Can you buy the 23 low, betting it's a small pullback bull trend? You probably can, but you're pretty high up in the range. Can you sell the 23 low? Nope. What about the 24 low? Let's say 24 is a bear bar closing near its low. Can you go short? I would get out of longs. Some bears will short, but I think it's more likely a minor reversal, maybe a 50% pullback to the moving average, and the breakout point, the 20 high. So not good enough for a stop entry bear to sell yet. End of the hour. Bulls want the hour to close above the red line. They'd like to get a bull body on the 60-minute chart, and the bears want a bear body. You can see probably more buyers 23 low than sellers. But if 24 has a bear body, a lot of bulls will get out below 24. And as I said, not bearish enough yet to sell with a stop below 24. I'd wait to see if we get 2 or 3 bear bars. Can you be scalping longs? If you buy above 16, you can take 5 points off. I would not. I think if you're long, you're going for a 20-point swing. You can get out if something is bearish. For example, if 24 is a bear bar closing near its low, you can get out. But then you look to buy again a bar or 2 later if we get a high one buy signal bar with a decent bull body. And for the bears, a double top. They're trying to copy yesterday, upside down version of yesterday, but not bearish enough, I think, to sell. That's the end of the hour. On the 60-minute chart, it's a pullback and a small pullback bull trend, but it's a bear doji. The prior bar was a bear bar, and we're at the top of a potential trading range. So not a good stop entry buy above that bar. On the 5-minute chart, if you get out and you're trading always in, you have to buy again. You can either buy above a bull bar, maybe 25 will be a bull bar, or if 25 becomes a really big bull bar breaking far above 24, you'd buy on a stop above 24. So you're either buying above a bull bar or you're buying at a new high in the leg. And for the bears, I'd wait to see if we get 2 or 3 consecutive bear bars or a micro double top and then sell. Still a small pullback bull trend, still always in long. You could be long, stop below 21, or you could get out here below 24 or at the market, and then buy again if 25 is a bull bar, especially a bull bar closing near its high. This is not trending behavior. When you look at this, you say, you don't look at this and say, wow, what a great bull trend. You look at it and say, it's kind of crummy. It's a trading range trying to become a bull trend, and it's an early bull trend, but for the bears, it's still a lower high below 1, and it's still possibly a lower high major trend reversal. Slightly more bullish than bearish, but when you look at this, you don't say, oh my gosh, I got to buy it. This is so bullish. It's not. It's a weak rally, and we're at the top of a trading range. So better to wait to see if we get a good buy signal bar 25. So what do you do if 25 is a bear bar closing near its low? You'll get more bulls selling out of their longs, giving up, and you'll get more bears shorting. But for the bulls, they're trying to hold it above the moving average, hold it above the breakout point, the 20 high, and then they'll try to get a bull bar, and then they'll try to resume up. What happens if 25 has a one-tick bull body? Do you buy? That would be similar to 17, small bear body. Better to wait for a second sell, and we did not get a good second sell. 21, 20, I said there'd probably be buyers below. Market's deciding. Is this going to remain a trading range day? Is it going to continue up as a bull trend? Will it reverse down into a bear trend? Don't know yet. We're going to break out of the range. The range here is only about 15 points, not even, which is extremely small. So not only will we break out of the range is going to double. So it can double in 3 ways. You break out of the top and go up for a measured move. You break below the bottom, go down for a measured move, or you break out of the top a little bit, go break out of the bottom a little bit, and then come back into the middle of the range. Bears are hoping this double top leads to a major reversal. Bulls are hoping this is a pullback from this, and then we get a higher low, a head and shoulders bottom bull flag, left shoulder, head, and right shoulder. We're back below the breakout point, 20 high. Not good for the bulls. I'm going to get rid of that. Is it sell the close yet? Not yet. If 26 closes on its low, closes below the moving average, you might get some bears willing to sell, but it's still in the middle third of a trading range. So really not good to buy high, not good to sell low. And if you do, better to trade small and then add on if it keeps going your way. If it reverses, you get out with a small loss. When things are not all that clear and you really want to get in, you trade small. And small, 20% of your normal size. If you normally trade 5 micro E-minis, you trade 1 micro E-mini. If it keeps going your way, you add a second one, a third one, fourth one. Can you buy the close betting this reversal down will fail? Well, you could, in trading ranges, a lot of times, if it sells off 2 or 3 bars, there'll be more bulls buying the close than bears selling the close. If it rallies 2 or 3 bars, there'll be more bears selling the close than bulls buying the close. Trading ranges, you're looking for reversals, so you got to think opposite. Anything bullish is a sell, anything bearish is a buy. Well, most traders should be just waiting for decent stop entry trades. And we really haven't had any today. Selling below 13, not great. Buying above 16, selling below 24. None of them is very good. None of them has a lot of potential for leading to a 20-point swing. For leading to a 20-point swing. Two hours into the day in a 15-point range. really unusual, very, very small. I say really unusual, very, very small. Back in the 80s, when I began trading, the average day's range was about 7 points or 8 points. And sometimes an entire month would be 30 points. So it's a much different market from, 35 years ago. Bulls trying to get a higher low. They're hoping that this is a pullback from this and a breakout test of the 5 signal bar high, 16 high. They bought above 16, and we're testing that 16 high to see if they'll buy again, and it looks like they're buying again. For stop order bulls, they want as good a bull bar as they can get, 26. And for the bears who sold below 24, they're buying back the shorts. They don't like to see it go down a few points and then reverse up. So bears are buying back shorts. And for the bulls, not a great buy signal bar, still always in long, but enough of a sell-off, a lot of the bulls will wait for a high too. So if you buy above 26, I would trade small. It's probably better to wait to see if we go sideways for a few bars and form a high two. And for the bears, if you did not exit as 26 turned up, I'd get out above 26 instead of above 24. You got to trade the market that is in front of you and not the market that you hope it becomes. And right now, we're in the middle of a small, very small trading range day. So if you take any trade, trade small and higher probability, wait for things to become clear, which they're not. They're still unclear, and unclear equals more trading range. So buying above things, selling below things in a very tight trading range, very difficult to make money because there's not much room. Buying above 8, buying above 11, buying above 21, 22, 23, not much room. Selling below 9, selling below 15, selling below 17, selling below 24, 25. All of those stop entry trades have decent signal bars, but they were all losers. So in a trading range market, it's mostly limit order scalpers. And, you really should not do that. It's difficult to do. And sometimes you'll get this. So you're selling at the high and then you get that. And what do? Or over here yesterday, you sell that high and when do you get out? Do you sell more? You sell more. The losses can be very, very big for limit order traders. Better to be a stop order trader. Now, I said bulls should exit below 24, and they could buy again above a high 1, 26. But the two big bear bars in the weak 5 signal bar, I would not buy above 26. I would wait to see if it goes sideways and get a micro double bottom, maybe 28 or 29. Now, what happens if it just keeps going up? Then you buy either on a breakout, stop, one tick above 24, or you wait to see what the breakout looks like and then buy the breakout. Bulls want a breakout above the head and shoulders bottom and a measured move up. And the bears so left shoulder, head, right shoulder. So we have a double top. The bulls want to break out of the double top, which is the neckline of the head and shoulders bottom, and they want a measured move up. And the bears are hoping this double top breaks below the neckline here and goes down for a measured move. And what's more likely? No, it's probably slightly more likely up, but it's not like 60% up, 40% down. It's like at the moment it's probably 52% chance we do that way and 48% chance we do this way. The market would not be doing what it's doing if the probability was high that it would go either up or down, right? The market is telling us that it's not clear. That's why it's reversing every few bars. So the probability of it going very far up or down right now is small. That most traders are better off waiting until it becomes clear, like yesterday, 35, 36. A lot of times the market will try to duplicate what it did yesterday or do the opposite of what it did yesterday. Yesterday we had the double bottom and the bears would like to get a double top today. Yesterday it became clear on bar 37. So today we may go sideways and then try to break out in either direction on bar 37 again. Bears are hoping double top, an early bear trend. 27 is a low one, but middle of the trading range, I would wait. And today we remain on a 15-point range. It's possible. Back in the 80s and even into the 90s, some days the entire day's range would be 4 points. 4 points. That was the entire day's range, 16 ticks. Now everything is about 4 or 5 times bigger than in the 80s. So 4 or 5 times 4 points is 15 to 20 points. So it's possible. Today's range will remain this size all day. It's not likely. Probably an 80% chance we're going to get a breakout and an attempted measured move up or down. Market's deciding head and shoulders bottom, do we go up, or double top, do we go down? Yesterday, bar 37, 38, that's when it became clear. So that's another hour from now if we do the same today as we did yesterday. Remember I said, don't buy above 26, wait to see if 28 or 29 is a bull bar closing near its high. Bulls trying to get a better buy signal bar 28, but it would be better if the bar does not become too big. The bigger it is, the greater the risk. If you buy above 28, stop below 28, so you have greater risk and you have lower probability because the bigger the bar is, the higher up in the trading range you're buying. So the math becomes worse for stockholder traders when the bar gets big like this. And you still buy above 28? Well, it's similar to selling below 24 or buying above 21, buying above 22. Not very high probability. Big picture, we're still on the buy above 16 if you put a stop below 16. So it's still, the Walmart trade is, long, one tick above 16, a stop below 16, and a target, a limit order about 20 points above the 16 high. So the Walmart trade, if you bought one tick above 16, put a stop one tick below 16, and placed a profit-taking limit order 20 points above 16, and went to Walmart and came back in a couple of hours, you'd still be on that long. Is it a Walmart short below 14? I don't think so. We had 5 consecutive bull bars, so I would not sell below 14 or 15. So you're still on the buy above 16, but really not very good here. I think it's probably better to be flat. If you buy above 28, stop below 28 or below 26 and trade small, and then add on if we break strongly above the double top. So if you buy above 38, you might trade small, buy more above 42. Here I'd wait for it to get close to the moving average, buy more here, or maybe here, or here, or here, or here. There's hoping for a double top pullback, so a double top 1224 reversal down, and they're hoping this is a pullback from that double top reversal. So they're trying to get a sell signal bar 29, and the bulls are hoping that
this is a pullback from this, and we're resuming up. Most of the bars are closing above the moving average, and you can see, we started down here, now we're up here, so we're still kind of heading up and to the right, but not very bullish. Remember on the open, I said 75% chance we would have at least a couple hours of sideways to down trading that begins before the end of the second hour. Well, it began right on the first bar of the day. So now that we've had those 2 hours, what do? Well, it's a trading range, so it's breakout mode. You look for patterns. You look for a good-looking sell. You look for a good-looking buy, or you wait for a good breakout up or down, or you wait for a breakout up or down to reverse. I said the bears are hoping this is a double top, and this is a pullback. That's a pattern, and I call it a double top pullback, a very common pattern where you have a double top and then a pullback. It's a variation of a wedge, right? Anytime you have 3 attempts to go up, you can call it a triple top, you can call it a wedge. It's all variations of triple tops. There's a double top and a pullback. There's a double top and a failed breakout, but again, 3 pushes up. Double top and a breakout. A triangle has 3 pushes. A wedge, expanding triangle, 3 pushes. A wedge has 3 pushes. Double top, a reversal attempt, it failed, and it formed a pullback from the sell-off from the double top. So double top pullback. 3 highs, a double top, and then a lower high. There's a bigger version of it, double top, and then a lower high. This is a pullback from the reversal down from the double top, and then the bears continued down. A lower high double top, and this reversal up was simply a pullback from this, and then we continued down. A small double top and a pullback to a lower high, even with a really good looking bull bar. And then we continued down. Lots of variations. A double top and a pullback. It's also a head and shoulders top. A small double top and a small pullback. On a 1-minute chart, it would be a bigger double top and a bigger pullback. A double top and a pullback. A double top and a pullback. A double top and a pullback. Higher high double top and a pullback. The bulls were hoping for a reversal up, and it was simply a pullback from this sell-off from this double top. Bears trying to get a double top and now a pullback. Now, if you bought above 28, aren't you disappointed? 29? Well, a lot of bulls are. So what are they doing? They're selling out of their longs, and that's creating the bear bar on 30. Now, what about shorting below 30? Not really that great, right? When you're in the middle third of a trading range, that's the absolute worst place for stop entries. Buying above 11, buying above 21, selling below 24. So clearly not good for the bulls, but not good for the bears either. It's more of a limit order trade. Better to wait to see if we break strongly above 24 and then buy higher, or wait until we break strongly below 26 and sell lower, or wait for a better looking buy signal bar. Remember I said 28 was too big. It would reduce the number of bulls willing to buy above it. And for the bears, 29, nobody wants to sell below that. So, better off waiting. Still on the buy above 28. We're still always in long 16. We're still on the Walmart trade above 16. I would get out below 26 instead of below 16. Bulls hoping to break strongly above 24. And then they want the measure to move up. Remember, I think, we're in a bull trend from yesterday. We have a good buy signal bar of 16. Most of today's bars are above the moving average. So even though we're in breakout mode, I think it's slightly more likely that we go up here than it is that will go down here. But as I said, it's not 60%. It's better than 50-50, but not 60. Can you buy on a stop above 21, above 24, or on a stop above 1? You can. Higher probability to wait to see what the breakout looks like and then buy after you see the breakout or after you see the follow through. Can you sell with a limit order, 24 high, 1 high, and bet the breakout will fail? Limit order bears will do that, hoping that we get a wedge, 3 legs up, 1, 2, and then 3. So they're hoping for a wedge rally to a double top. But most traders are better off waiting. Wedge, 3 legs up, 1, 2, and then 3. So they're hoping for a wedge rally to a double top. But most traders are better off waiting. Remember what I said earlier that when you have double tops or double bottoms, the second leg, a third of the time it's climactic like that. And 2/3 of the time it's like that. 3/4 of the time it's like that. No, that's really not correct. I'll change that later. Double top. Fairly climactic. 6 bull bars. Double top. Higher high double top. More often it's some kind of a wedge, a weak rally to a double top. Weak rally. So will we break strongly above 24 and above 1? We might. I think we're always in long, and I think it's more likely we're going to go higher. For the bears, if they get a good sell signal bar 31, that would be a credible sell. But the bears would need a bear bar closing near its low with a decent sized body, at least a point or two bear body. And bulls are hoping for this. They're probably not going to get it, but the bulls buying with a stop, 1 tick above 24 or 1 tick above 1, are hoping that's what they get. And if they don't get it, they'll be quick to get out. All right, I'm going to step aside, and Brad is going to start talking. Breakout mode, bulls trying to get a breakout. Bears want the breakout to fail, and they're hoping we form the high of the day either here or in the next few bars. Okay, have a good day.
Thanks for that, Al. Market's trying to get an upside breakout. Let me just check one thing here. The bulls are, let me turn the bar counter on real quick. I have a new microphone that I'm trying to adjust and make sure that the sound is okay. Perfect, okay. I'm glad to hear it's sounding okay. So let me see here. Let me turn on the bar counter really quick. All right, so always in long and 4 consecutive bull bars. It's possibly 2 legs. Whoops, thank you. I just switched that over. I was adjusting something on the chart. So it's still always in long and trying to break above the high of the day. One thing's, we're pretty sure about one thing, and that is we're probably going to get the measured move up or down. And At the moment, it looks like we're going to try and break to the upside and get a measured move up. But until there is a breakout, there is no clear breakout. For the bears, they will see this as two legs up, double top with bar 1, and they want a bear bar. And ultimately, they want to test back down to the 16 low. Bull bar closed above 30, good for the bulls, but closed at the midpoint, and it's a fairly tight channel. But 31's a warning. Why did 31 fail to close on its high? Fairly tight channel, but 31's a warning. Why did 31 fail to close on its high? So that makes traders question if this breakout is going to be successful, but too early to sell. So what do you do here? Most traders should probably wait for a clear upside breakout. This could easily reverse down. We're high in a trading range, and that will increase the probability of the market testing back down. So until the bulls get a clear upside breakout, there is no breakout. It's easy to be disappointed on a day like today. It's easy to become hopeful, hope that there's going to be an upside breakout, and you end up buying too early. The most important thing here is to just be patient. Let me adjust one thing on this microphone. Give me just 1 second. And again, as far as looking to sell, it's probably better to wait. I'm going to turn the screen on in just a moment. So there we go. I just wanted to fix one thing, and I think I've about got it fixed. So just one more second here. So the market's deciding what to do here. Any one of these can be a possible top. So we have the high right here. For the bears, they will see it as a double top with 1. So they will see a possible double top with 1, and it could be with 1, it could be 2, but either way, so far it's a tight channel, but if we don't break strongly above, we'll probably fail and the market can turn down. Bears are not making money selling below bars though, and that is a problem for the bears. Here is a 60-minute chart trying to break above the range. So let's see what this bar looks like. Will 33 close on its high, or will 33 be disappointing? Can 33 close above the 1 high? All of those are important. I'm looking at the Discord, so feel free to ask questions along the way. So far, getting a fairly strong breakout to the upside, so have to be thinking about some kind of measured move. Measured move from the 16 low to the 24 high, a measured move from the overall range. But so far, this bar looks pretty good for the bulls. the bears will try and create disappointment on this bar, and the bears will try and drive the bar down into the close. This is why it's important to wait for the bar to close. Spending a lot of time at the middle of the bar. And if we go to a 1 minute chart, decent rally, but that's a pretty deep pullback. And that is not what you want to see for a breakout. The bears, you have bears that sold the 1 high, they sold the 31 high, and they're trying to make money. And they probably will. Some bears, they sell the 1 high, and their entry price is 42 even, or excuse me, they sell the 31 high. Their entry price is 42 even. Maybe they sell, they could easily sell 3 points higher, 2 points higher. And right now, they have the opportunity to break even. And the reality is they're probably going to have the opportunity to make money and exit at their original entry. So to me, that increases the chances that the market is going to test down to the 31 high. Disappointing close for the bulls. So not really ideal. The bulls can still see this, the bulls might see 33 as a breakout pullback, breakout on 33, pullback during the bar, and then a second leg up. So the bulls need to get a strong reversal here. And the bulls need to get a strong upside breakout and undo the damage of the tail. Does it matter that we're in lunch hour? Not really. I get the argument, and you can argue that it's lunch hour, therefore there's not as many traders trading. But the reality is, I think in today's world, if you have institutions that are trading, every conceivable minute that the market's open, and they're in, every country in the world. So to me, you may have a bunch of retail traders not trading during the lunch hour, but there's still going to be plenty of volume trading at the moment. So you can, this is the market deciding whether or not the breakout is going to break successfully to the upside, or if the market is going to reverse. I want to pull up a chart. It's always kind of a fun one to show. It is. It's loading right now. Give me just a second and I will share my screen. So this is a chart Al would always show pretty regularly in the trading room back in the day. And it is December the 31st, 2009. And you can see back in 09, just how small the bars were. These bars are very small, but you had a very tight range for the majority of the day, sell off, and then very tight range, and a very sharp reversal that started with about 30 minutes left in the day. And I think it's always a good example of, it's a great reminder that a breakout can happen at any given moment. So for the bulls, how are you feeling if you bought the breakout on 32, above 32, 31, or the 1 high? You're obviously disappointed. And a lot of traders who sold and scaled in made money. And for a breakout to be successful, you need traders to get trapped. That's what I think. I think that's one of the most important things to remember with trading is understanding who's trapped. If you think about it, think about breakouts for a second. We had a great example yesterday. So when you look at this, pick a bar. Obviously what I'm talking about is right here. A strong breakout will trap traders. It'll trap traders into a bad trade and force them out of the trade. So if you're a bear and you sold below any of these bars, it's reasonable to think that there's going to be a second leg down. So if I'm a bear and I sell the 32 close, maybe I sell the 33 low, or I sell above a bar, or maybe I sell above 31. Look what happened. So I sold, I scaled in, and I get trapped on this big bull bar here. Well, for me, what am I doing here? If I sold and I'm trapped, I never really had an easy way to get out of the trade. So if I sold and scaled in, I'm even more trapped, and the market did not pull back and allow me out of the trade. So it's a pain trade, and it forces the market up higher. What about the bears all through here? You had bears that sold the 2 high and sold more during 3, or they sold the 3 close and they made money. Bears sold here, scaled in, they made money. Even the bear that sold the 6 high made money. Bears that sold the 18 high sold more, maybe at a new high of the day or somewhere up here. They made money. So the point I'm making is you always have to think about when traders get trapped. And if limit order traders begin to get trapped, that means that will increase the odds that those traders will give up. Bears, kind of like right here. Look at the 34 low. If you sold the 32 high, you were probably disappointed on 33. You sold this high, you sold more higher. What did 34 do? 34 gave traders a brief window to sell more higher, and most importantly, exit at the 32 high. The reality is we're probably going to come back to this high, the 32 high. But you always have to wonder. The market tested the 32 high here, allowed those bears out, and then rallied. Let me check one thing. So the bulls are still trying to get an upside breakout here. 34, breakout, pull back to 34. So a buy above 34, but it's a bear bar. And that will lower the trade. That will lower the probability as well. So the bulls are really trying to get pretty much an endless pullback and an upside breakout. But to me, something looks wrong with this breakout. And that will increase the probability that we're going to sell off back down to this area. You can see more sellers above 34. Traders sold the 34 high. Bulls sold to exit longs, and the market turned down. One of the single most important things, especially on days like today, is to be patient. I think it's really easy to get too excited. It's confusing in here, and it's hard to take trades unless you're, trading with limit orders. And by the time it starts to go up, traders start selling. By the time it starts to be clearly bearish, bears start buying back shorts, bulls start buying aggressively. Traders buying in here, but it's hard to do after 3 big bear bars. So it's really confusing. And unless you can use wide stops and scale in, it's even more difficult. So a lot of traders, it's very easy to, as the day goes by, if you haven't taken many trades, to become impatient and start to do things more that are irrational, which lead to pretty big losses. So, buying up here, hoping for the breakout, and rather than waiting for a strong bull bar and then a follow-through bar, it really isn't, it can really be a mistake, because if you're buying up here, the problem with it is, where's your stop? If you put your stop down here, that's a likely target for the bears, and the market could easily test down to it. So if I'm a bull, for me, I would get out below 35. Remember what I said? The bulls needed to get a breakout, and they weren't getting it here. To me, this is not what you want to see if you're a bull. Sure, there might be buyers below 35, but to me, it's a problem. It's a reminder that the market is still within a trading range. And if the market's still within a trading range, we don't know where the bottom could be. 24 low, it was reasonable to sell below 24. You'll have some traders sell below 24, sell more above 24, or even sell somewhere up here, maybe above the high one. And a lot of those bears might have limit orders to buy back shorts at the 21 low. So not all that clear. The bulls, they broke above the one high. They're pulling back. They're trying to get another breakout above the one high. We had the 18 bar range right here, and we broke above it, which was the one high. We broke above it for basically 2 bars, maybe 3 if you want to include 34. So we broke above it, pulled back, tried to break above it again, and pulling back. And, to me, since the market only went 1 or 2 bars above the 18 bar range, if it starts to turn down, we could still get back down to this area. The bulls are trying to get a second entry buy. That would be better for the bulls. But you have to wonder, whenever you get a bull flag that is pretty much at resistance, such as the one high, you always have to wonder about the flag failing. So in other words, the buy signal triggering and then reversing down. And that would create a measured move. In this, you measured move from the high of 33 to the low of this current bar, which would take you down to the 26 or 28 low. 2 minutes left in the bar. You have bulls that bought the 35 low, and they bought more lower, deciding what to do here. You have some bulls that bought the high one above 34, even though it wasn't ideal. They probably bought more lower, and they may look to scalp out. I suspect there's going to be something wrong with this signal bar, something probably disappointing about it. Always in long, but I question by to what degree. I think the market's barely always in long. And because of that, it doesn't take much for the market to reverse. Decent buy signal closing on its high. Always in bulls, they can buy above it and put their stop below 36. Second entry buy, top of the trading range. It's a low probability buy. And if you buy it, you're hoping for some kind of measured move. If you buy above it, maybe you put your stop below the low right here. And, a lot of traders, they'll buy below this bar, enter here, and maybe they'll go for a measured move up. So the risk reward makes a lot of sense. For me, if I'm buying above 36, I would not put a stop all the way down here, because to me, if it falls below 36, it could very easily be a failed breakout of a trading range. And remember what I mentioned about the measured move down? You always have to wonder about the potential of this. So second entry buys in strong trends are, 60% trades or higher. Second entry buys at the top of a trading range have a much lower probability. They're a lot closer to 50-50. So that's why if I'm buying above 36, I'd put my stop below 36, even if the market just falls below it and reverses up, because I do not want to have bad risk reward if I'm buying at the top of the trading range. And if this is going to be a strong breakout, we really should not fall below a decent signal bar. The other problem with the signal bar is it's a small body relative to the tail. Look at the bar. Here's the body of the bar right here. And if you think about it, it's pretty much, the body is about 1/3 the size of the entire bar. And, do you really want that? You really want a signal bar to have a bigger body. It's good that the bar sold off and then reversed up strongly and closed on its high. That's good for the bulls. But it does weaken the probability a little bit that the body isn't that big. Now, would I sell above the prior bar? For me, I would not. It's a second entry buy in what's probably an always in long market. I think most traders are better off waiting. Either traders are buying above 36, stop below 36, and they're hoping for the measure move up, maybe a 50-50 chance they get it. But even if it's 50-50, or even if it's slightly less than 50-50, their stop's down here and their target is somewhere up here, they are going to achieve more than twice the risk. It's one thing I talked about in that, I've talked about it before, but whenever you have, I'll see if I can pull it up in a second, as far as the trader's equation, give me one moment, I'll pull it up. So this is what I was talking about. If I bought above 36, I would get out certainly below 36, probably get out below I probably would get out below the low of 37. There we go. I think one of the biggest problems, I really want to see if I can pull this up really quick. And I think it's right here. Give me one moment. Perfect. I've got a spreadsheet I want to show in a few. And anyways, I think one of the biggest challenges people face with trading is they take too many trades with 1-to-1 risk reward, and they cannot assess the probability quick enough. So what traders end up doing, they buy above 36 and they put their stop below 28, thinking Al always says to buy above 36, put your stop below 28, and they generally have the right idea. But the problem is they mismanage the trade. They're not quick enough to get out, and they end up risking. They have terrible risk reward on probability that's not that ideal. They buy above 28, they buy more here. So their risk reward is in essence 1-to-1, here to here. And they're not able to necessarily scale in, so buy more, and they misjudge the probability. That's why a lot of traders would be much better off trying to find trades that have decent risk reward, buying above bars like 16, stop below 16, going for twice your risk. That's why I also said buying above 36, putting your stop below 36, and holding for twice your risk. I'm going to go ahead and show this really quick. This is the spreadsheet. I've shown it several times, but the reason I'm showing it is it's a very easy and reasonable illustration of the trader's equation. Probably always in long and going lower. So this is what I talked about. I said this was a bull flag. Traders buying, so we have a high 1, high 2. It's 2 legs down. Bull flag means pullback and higher prices. So whenever you're in a trading range, I always assume it's at least around 50% that the other thing could happen, the other thing being a downside breakout. And right now, this is what's trying to happen. So I would not be surprised if we get down to the 28 low. High 2 buys. Whenever you get a high 2 at the top of a trading range, you always, you really do, you always have to wonder if it's going to fail. Whenever you get a low 2 at what could be the bottom of the range, low 1, low 2, you always have to wonder if it's going to fail. Now the bulls are trying to reverse the 38 close, and they're trying to get a buy signal here, and that would be technically 3 legs down. So leg 1 to 34, leg 2 to 36, leg 3 to 38. But to me, if I bought above 36 and bought more below 36, I'm probably disappointed enough that I may be trying to get out, break even on the entire trade. So this rally here might be more due to traders trying to exit on a bounce than bulls aggressively buying. I want to show this chart really quick. And I've shown this, quite a few times off and on, but most traders, if you think about it, and you look at these different scenarios, if you're risking $1 to make 50 cents, or you're risking 1 unit to make half a unit, if you're 70% profitable, that is your return, 0.05. And the reason I'm bringing this up is these two examples in the middle. I know this sounds simple, but I really think a lot of traders do not think about just the basics of the trader's equation. Because if they did, it would save them from a lot of mistakes. So think about these two scenarios. You've heard Al, if you've been in the video course, if you've been in the trading room for any period of time, you've heard this discussion before. But it's really, really important. If you're 60% profitable at 1-to-1, it yields 0.2. If you're 40% profitable and you're risking 1 unit to make 2, it yields 0.2. 0.2 is a pretty much minimum. I mean, the reality is if you have a 1-to-1 risk reward, you're risking 1 and your reward is 1, you really 60% is like a probability to where you might not lose money after commission. You're not going to make anything. You will barely make money probably after commission. That's just the reality. It's the same thing with, risking 1 to make 2. 40% is kind of that minimum threshold you want to be at. So if you're looking at both of these and you had to pick a direction, you could either choose this top one or the bottom one. So in other words, which would you rather pick? Would you rather go for 1-to-1 and try and be 60% profitable? Or would you rather risk 1 unit to make 2 and try and be 40% profitable? The reality is the bottom one is going to be easier to achieve. And the reason I'm bringing that up is here. So let's assume that, or better yet, let's just make it simple. Which one of these is easier to, perform better in? It's going to be the bottom one, because if you can risk 1 to make 2, I think Tim talks a lot about this whenever he's in the webinar, but if you can risk 1 to make 2, and let's say you can become 45% profitable, your return is now 0.35. If you're risking 1 to make 1, and you're 70% profitable, you will outperform. But if you're 67% profitable, that will be the same. So anyways, the point is, if someone can get closer and closer to maybe 50% or even, 48%, they're going to have a much better chance at being profitable faster than someone trying to go for 1-to-1. And I'm bringing that up because if your risk reward's bad, 1-to-1 is a bad risk reward. And if your risk reward's bad, then you really have to understand the probabilities really, really well. And the last thing I'm going to say with this is going for anything less than 1 times your risk. So let's say you're going for, 3/4 of your risk. You're risking, 4 points to make 3 points. I've got that backwards. Let me just do it like this. So this is in essence, your unit is 1 and you're going for 3/4 your reward. If your probability is 80%, you will beat going for this down here. Anyways, I'll talk more about that in a minute. So now the bulls have a wedge bottom, 3 pushes. Down on 34, up on 35, down on 36, pull back, and then down on 38. So what do you do here? The bears will see 39 as a breakout pullback sell. The bulls will see 39 as a pullback from the 36 breakout. Some bulls will say 36 is the first leg, 37 is the pullback, and 38 is the second leg. So if I'm a bear, I think it's okay to get out above 39. It's reasonable. You'll have some traders sell at the 37 low. Some bulls They bought the 37 low, disappointed on 38, some of them deciding what they should do here. The bulls still have a chance, and they're trying really hard to get the upside breakout. But, again, top of a trading range. And that always makes me a little bit suspicious. So you can see the bulls that bought above 36 and used a wide stop, maybe below 28, bought more below 36. They are able to get out here. So even though 39 looks like a decent buy signal, I'm still suspicious. And in part, I'm suspicious because of this right here. Some bulls bought above 36, bought more below 36, and they may use this bounce to take profits. And if I'm a bull and I bought above 36, or if I bought above 39, to me, I'm going to be pretty quick to take a loss if it doesn't immediately go my way. So that's why I think a lot of traders, when they saw 37 closes the bear bar, a lot of them would exit. So a lot of the bulls that buy above 38, if 39 is a weak bar, I think a lot of them may exit the trade. But so far, it's looking decent for the bulls. Anyways, back to my point on this, just to keep it really simple. If whenever you're going for less than 1 times your risk, let's say you're going for half your risk, you're risking 2 points to make 1 point, 4 points to make 2 points, etc. You've got to be 80% profitable to yield 0.2, which is the same thing as being 40% profitable, risking 1 to make 2. So anyways, the point with bringing that up is traders have to be very cautious and aware of probabilities. Too many traders, a good example is selling down here. It's not great, but if you sell the 15 close, stop up here, you can't just wait for the market to stop you out up here and then just say, oh, well, this time the 60% didn't work. You have to be able to exit the trade quickly. And a lot of traders, if I sold the 15 close and the sell-off, it started going down and then started to turn up, I'm getting out. And I'm especially getting out somewhere in here. If I wasn't, there's just too much risk of it not working out. And if the market's in a trading range, gaps are going to close. So we have a big bear bar on 38, and the bulls are trying to reverse it. But there might be more sellers above the 38 high, which means the bears, in other words, where I'm getting at is bears sell the 38 close and they sell more at the 38 high, which means we could easily pull back somewhere down to here and allow those traders out. So the bulls are trying hard. Still about 30 seconds left in the bar. And the bulls obviously want a second leg trap, 2 legs down. Leg 1 at 36, second leg to 38. You can see 38 tested around the 24 low. Some bears, they sold 24. They sold more below a bear bar, like 37. They were able to exit the trade right here. A little bit of a tail on 40, but good bar for the bulls. Increases the chances that the market's going to go a little bit higher. But still not clearly, it still hasn't clearly broken out above the range. Bar 1 high is right here, so we're still under the bar 1 high. And the bulls that bought above 39, they have not made a stop entry profit yet. The market has gone 2 points. So if you sold the high of 39, your entry price was 41 even. And some traders, they will sell, maybe 1 point higher at 42 even. The market's gone to 42.25. So it'll be interesting to see, will the market fall back to 41 even before it goes up a little bit higher? Testing back to the 36 high. The open of this bar gapped up slightly compared to the close of the prior bar. That is good for the bulls. Again, remember what I said, there might be more sellers above 38 than buyers. This is basically a second leg trap, leg 1 to 36, pullback leg 2 to 38. And often, second leg traps lead more to sideways trading than reversals. So for me, if I'm a bear and I sold the close of 38, I think it's reasonable to sell more above 38. And a lot of those traders, they might be sufficiently disappointed where they will just try and exit break even, which is the middle of this line right here. And it's basically the close of 1145. So you have to wonder if the market's going to pull back here to around this price level and allow those bears out. Bulls trying to get a strong reversal up, some kind of measured move. So far, they have a small micro gap, high of 39, low of 41. Right here, that's good for the bulls. So let's see how this bar closes. Can this bar close on its high, or will it have a tail? A few seconds left in the bar. Good close for the bulls. Probably back to always in long, but getting close to the area where the market sold off. So there's probably more sellers up here than buyers. But strong enough breakout to the upside, 39, 40, and 41. First reversal down will probably fail and lead to a second leg. You can see the market gapped up, close of 40, open of 41, and the market gapped up on this bar, open of 42, and the close of 40, or close of 41. So it'll be interesting to see, will the bears make money selling above the 40 high? You can see 41 was a climactic bar, and there's profit taking, bears selling, bulls selling out of longs, betting that the market at least pulls back a little bit. So far, bulls unable to close the gap. Current bar low to the 40 high. That's good for the bulls. So you can see we're 2.5 minutes into the bar, and we have not gone above the prior bar. That's a warning that something is not right here. Something is wrong with the bull case. We can still go higher, but to me, if I'm buying a breakout, I don't want the market to spend the first 3.5 minutes, 4 minutes of the bar not going anywhere. It's a perfect doji right now. So where is the increased buying pressure? That is a sign of hesitation. So to me, I am suspicious. I think this is an area where bulls may take profits and bears may start selling more. And to be clear, I think the odds are the bulls are going to get at least a small second leg. But, you know, when the market starts to hesitate in this area, it makes me very suspect of wanting to buy aggressively up here. Another thing that I think is kind of hard to visualize is this sell-off to 38. It's so easy to look at this rally and think, oh, the market's reversing this sell-off from 32, 33 to 38. But, you know, I think it's important to kind of play around the time frames and learn to visualize what other time frames may look like. So here's the sell-off, 32, 38. And this is a 15-minute chart. If I go to like a 7-minute chart, here is, or a 6-minute chart, we have the sell-off. So let me just back up. Here's the 5-minute. We sold off. Here's the 38 low, the second leg trap. But when you look at like a 15-minute chart or a 20-minute chart, you look at this and you see a big bear bar, and we're above the bear bar. So there might be more sellers up in this area, and the market can come all the way back down to here. 30-minute chart. You can see we triggered the sell below. There might be more sellers up here. So the point I'm making is I think at a minimum, we're probably going to have a fairly disappointing pullback here the bears that sold to 38 close or above 39, they're probably going to be able to scale in and avoid a loss. Most of the time, this is not what happens. You get a sell-off and then an endless pullback that breaks strongly to the upside and traps anybody that sold. More often, you get disappointment. You get a sell-off like right here to 16, and then a strong reversal up to 23, and then a very deep pullback to 27 that allows any of the bears that sold and sold more to exit. So that is what I'm saying. I think the reality is bears that sold here and sell more higher are going to be able to avoid a loss. And if you're a bull and you understand that, that is going to make bulls less hesitant to want to buy up here. Why would I want to buy in an area where bears are probably going to scale in and drive the market down? So if I'm a bull and I bought down here, I'm probably going to be more interested in scalping out up here. If you want to keep it more simple than that, we broke above here, sold off. We broke above 33, sold off. We tried again here, tried again here, tried again here. So the Forrest Gump mentality would be we keep going to this price level and turning down. Therefore, if we've been doing that, I should continue to think that we're going to do that. And the other little tidbit is 38. It's not, it's a bear bar in a tight channel, but the reality is it's a trading range, and it's not the world's worst sell to close bar on 38, especially if you can use a wide stop. So if I'm a bear and I sell to close at 38, and I put my stop up here, somewhere up here, I sell here and I scale in, I'm probably going to be able to make money or certainly avoid a loss. And there's a reasonable chance that the market will get back down to the 38 close at some point. It's kind of the same as selling below here, scaling in. Trading ranges are very forgiving. A good example is yesterday. 18, it's reasonable to sell the close of 18, even though fairly tight channel, maybe low in a possible channel. It's not the best close, but the reality is 18, 17, and 16 should have had a second leg, and instead the market went straight up. But the market did not go a measured move up of the range. So if someone sold here and sold more up here with the stop up here, they clearly made money. And that happens very frequently. So what do you know? We're getting a fairly disappointing bar. So if I'm a bull and I bought the 41 close, and then I see this bar, am I excited? Am I saying, great, I can scale in, I can buy here and buy more lower? Some will, but stop placement is difficult. If this is a trading range, where do you think an obvious target is? One obvious target is the 38 low or somewhere down here. So if I'm a bull, the last thing I want to do is buy up here and sell right where more traders are going to buy. Same thing with the bears. If I'm a bear, the last thing I want to do is sell down here and sell more above the 37 high. That goes back to my one-to-one risk-reward discussion on that Excel spreadsheet. A lot of traders they're not quick enough to, when they sell this close, it's really not even great math. I mean, selling here, stop up here, kind of makes sense. I get it. But the reality is if you're selling here, stop up here, and setting a target just 1 times your risk lower, it's not that simple of a strategy, because you have to be very quick to get out. And, even getting out here is not that simple. So we triggered a sell below 42. Bulls will see it as a pullback, and now they want a second leg up. But unless the bulls get a strong upside breakout, the reality is we're probably going to fail up here and close the gap. We're probably going to get back to the 39 high and the 38 close. And I think that because the market is in a trading range. So the market went above 43 and it's starting to hesitate. If you bought above 43, is this what you want to see? Do you want to see the market stalling, or do you want to see the market break above 43 and start racing higher? You know, when you look at this, do you feel a sense of urgency to buy at the market? Because if you don't buy at the market, you're going to miss out on a move. Or does it look confusing? To me, it looks like a confusing picture. And typically in a trading range, whenever you think the market is about to become clearly always in long or about to become clearly always in short, usually the market reverses. So a good example is this sell-off to 15. It's becoming always in short, and it makes you think that, you know, maybe now the market is always in short. But then it reverses up and traders get out. Strong bull bar, probably always in long, then you get a deep pullback. Big bear bar, 38, maybe it's becoming always in short, but then it reverses. So the bulls trying to get the strong breakout. Let's see if they can get it. So far, looking good for the bulls. But you can see, market broke above the 1 high, sold off, trying to break above the 33 high. And, you know, bears that sold 33, let's see, if you sold the 33 high, 45.25, market went up to 47 even. So better yet, if you bought above this bar, your entry would be 45.50. So you would need the market to go to 46.75 to make 1 point. And it went to 47 even. So bulls were able to buy and scalp out for 1 point. But the size of this bar is, you know, 3.75. And it looks like bears were able to make money selling above 45.25. We'll look at a 1 minute chart. Well, you can see they were. So that is not a breakout that I really want to see if I'm a bull. The channel up's getting to be fairly tight from 38, but quite a bit of overlapping bars, trading range bars, dojis here, an outside bar here. You know, to me, this rally looks like a leg in what will become a trading range. Just take a look at a 15-minute chart. Sometimes that can be helpful. When you look at this rally today, 1 push up, so push up to 10:30, second push up to 11:15, third push up here. And you can look and see that we're testing the high of this signal bar right here. So when I look at this whole picture, to me, this looks like a trading range. And I still think we're going back in this area right here. So I am still suspicious of this rally. Just something, again, it's like what I said about 44. The market's breaking to the upside on 44, and it makes you start to think, you know, maybe I'm wrong. Maybe this isn't a leg in a trading range. Maybe this is a bull trend, and I should buy. And as soon as you think that, a few minutes later, something disappointing happens. And now, you know, what if we bought the close of 44, or we were impulsive and we bought during 44? How are we feeling on 45? We're thinking, you know, darn, I really should have just waited. And that's another thing. Whenever you find yourself selling, and then 1 bar later, selling below like 15, and then on 1 bar later, it immediately kind of reverses aggressively against you, or you buy 44 during 44, and then the next bar immediately reverses rather aggressively, it's a reminder that you're in a trading range. And an easy way to think about that is, you know, good bar and then disappointment. So good bar for the bears, then immediate disappointment. Good rally for the bulls, immediately bulls disappointed. Sell off, immediately disappointed. So the problem is, and that's the mentality of channels. Whenever you're in a channel, typically when the market gets near the top, it reverses. So that's why the market sells off, 1 push down, second push down, traders start buying because the risk reward is decent. If they buy, put their stop somewhere down here, they've at least got a 50-50 chance it's going up to here. if they buy as this bar is going down, put their stop below 28, maybe 50-50 chance the market goes up. But the reality is a lot of those bears that sell the 38 close, a lot of those bulls that buy the 38 close, they will typically scalp out below, they will typically exit the trade if the next bar is a bear bar. Give me just one moment. So what happened to all the eager bulls? 45 is what I was talking about. Bears sell, they scale in, and they make money. And, you know, I think that's just it's a really, I think, tough thing to learn, or I guess not really learn, but more or less accept. And that is limit order traders, they generally make money almost all the time, and they can almost avoid a loss just about in every scenario. That's why you hear Al all the time in the video course, in the books, when he's in the webinar. He's always talking about how 90% of the time the market is within a 40 to 60 band or range. And what he means by that is 90% of the time you can buy the 38 close and make money. You can sell the 38 close, scale in, and make money or avoid a loss. But it's also important to note that the bears are having the same problem as the bulls. Market does something strong, everybody sells it. Market sells off, does something strong, traders buy it. And the reason for that, I mean, the easiest reason, explanation is as the market rallies, traders sell out of longs. As the market sells off, traders take their profits and scalp. Look at the high of 39. Let me refresh the chart. I moved the bar number. The high of 39 is 41 even, and the low of this bar, 41.25. So if you bought on a stop one tick above 11.45, bar 39, 41.25 is your entry. The low of this bar is 41.25, so you got stopped out to the tick. Bears, I still think we're probably going to go one tick below 45 and allow these bears out. I still ultimately think we're going to get down to the 38 close. And the reason for that is we're in a trading range. Trading ranges, they rally for 2 or 3 legs and then reverse. Sold off, 2 or 3 legs down, reversed. So we have a wedge, 24, 33, and 42, or you could say bar 1, bar 33, and 44. Not great shape. 45 is a little bit of a surprise, and to me, that will increase the probability of a small second leg down. So there might be more sellers above 46 than buyers. But you can see we're getting more and more in the middle of the range. Low one short, 47, but doji, not really that great of a low one, probably buyers below. Some bulls bought the close of 46, disappointed 47. They buy the 46 close, and they're disappointed at 47, and they say, gee, maybe that was a mistake, so maybe I should try and exit back at the 46 close. So they buy, disappointed, and they try and get out back at the 46 close, which is in part why the market is selling off kind of right here. Bulls that buy and scale in probably will make money. But I still think the market may need to test somewhere down here. Not really a good place to do anything. The bears want a second leg down from the sell-off from the 44 high to the 45 low. Bulls want a second leg up from the sell-off from the rally 38 low to the 44 high. Testing the 45 close. Probably more sellers above. What about the argument that this is becoming a small pullback trend? the problem with that argument, the channel's tight, but the problem with the argument of a small pullback trend, small pullback bull trend since, the 16 low, is bears are making money on stop entries below bars. Bears made money through here. They made money selling below here. They didn't really make money selling below here, and the other problem is you have a decent sell-off here, decent pullback here, decent reversal attempt here. So this is pretty much becoming the fourth leg up in a channel. Rallied, pulled back, rallied, so the second rally, pull back, third rally, pull back, now becoming a fourth rally. Channels typically get weaker over time. And to me, that means that the market is going to transition, is more likely to begin to transition into a trading range soon. So unless the bulls can get a strong upside breakout, probably the market is going to be limited. Someone made an interesting comment in Discord. They said it's the worst trading day to watch so far. They don't want to buy, they don't want to sell. And that is a good example of trading ranges or channels. You can basically call it the same thing. Whenever the market becomes clearly bullish, everybody sells. When it becomes clearly bearish, everybody buys. So, and even Tim in the Discord, he's mentioned it a few times. The market sells off, traders buy it because they know that if they put their stop down here, and they don't even have to put their stop down here, because a lot of them, if the market doesn't reverse up on the next bar, and if the next bar, if 39 is a bear bar, they'll exit. But if they're buying down here, stop, somewhere down here, they've pretty much got twice the risk and a chance to make a new high of the day. Big bear bar, they buy the close, stop down here, and they take profits up here. Big bull bar, they sell. So to this person that said worst trading day so far for watching the market, I would ask you, think about doing the opposite. So take a look at the chart, and when you see a bear bar, ask yourself, what if I bought the bar instead of sold it? How would I do? And, this bar right here, good bull bar, but look, everybody sold it. Why did everybody sell it? Well, we have an inside bar here that's kind of like a final flag, and that is a trading range. We broke above it, and the reality is we're probably going to go back into this range. So to me, what do I think is going to happen? We're probably going to test the 45 close. We're probably going to test the 45 close. We're ultimately probably going to test the 38 close. And the reason is because we're in a trading range. Open of the day is right around the March high. That is also another magnet. And we're probably going to spend a good bit of time around the open of the day. For the bears, they have another form of a wedge, basically a truncated wedge, 33, 44, 49. You can also call it a lower high major trend reversal. So we have a bull trend, trend line break, new high, and then a lower high, 2 legs up. What would I do if this bar closes on its low? I would certainly get out of longs. And, it's probably an okay short, but it's a major trend reversal sell. Therefore, low probability. You want high probability, you wait for a strong entry bar and maybe a strong follow-through bar. But for the bears, anybody that sold down here and sells more higher is probably going to make money. So to me, I would certainly exit longs below 49. And the reason I'd exit longs, it goes back to risk reward. If I'm buying, an easy way to think through it is whenever you are in a trade, ask yourself, if I had to be if I was long and then I see 49, ask yourself, what would I do when this bar closes? In other words, it doesn't matter where you bought. If you bought all the way down here, if you're not willing to buy up here again and the market's here, that means you should exit the trade. So for me, if I bought here, if I bought the close of 45 and I'm long and I say, well, I was willing to buy 45, but I'm not willing to buy 49, that means I have to exit the trade. The logic of saying that, oh, well, I'd be willing to buy here, I'm willing to be long if I bought lower, but I'm not willing to buy here. That makes 0 sense. I get the logic, you can buy and take partial profits and swing trade and have a stop at break even. But really, when you're doing that, all you're doing is trading a lighter position. Probably sellers above 49. The bears are starting to collect a decent amount of bear bars, and that will increase the probability of a test of the open of the day. So it's a swing sell below 49. It's a micro channel since 45, not ideal. Some bears, they sell below 49, they put their stop above 49 and they get stopped out. Other bears, they put their stop above 44. Other bears, they sell more above 49. And there'll be other bears who will sell maybe a half size position. And if the market goes straight down, they'll build up to their position. But they sell a half size, get stopped out above 49. And then if they get another second entry, they'll double their position. So they'll trade a full size. Reversal on 50, but another high one buy, top of a trading range. And if you want to keep it simple, get rid of this line, get rid of this, and I see a range getting contracted. However you want to draw it, it does not matter. But the reality is, confusing picture, tight trading range, and pretty much breakout mode. This is a fairly dangerous market for most traders to trade. It looks easy, and at the end of the day, it's easy to look back at it and say, well, yeah, you buy above 16, and it's a strong rally, so you don't get out here, you hold through the first reversal, and then tight channel, you don't get out there. That's easy, but in real time, it's a second leg trap, leg one, pull back, leg two, and the risk is real that we sell off all the way to the 21 low. Strong rally, but rallied, pulled back below, so that's leg one. Rallied, pulled back below, rallied, pretty much pulled back below. It's a parabolic wedge, but it looks like a leg in a trading range, so the pullback could be very deep, and we got that. When you see this, you look at that, probably strong enough for a second leg down. Hard to just look at 38 and say, yeah, I'm going to buy it. And that's not so simple. So 51 trying to break above 49, but to me, there's probably sellers above 49. Traders sold below 49. Guess what they're going to do? They're probably going to sell above 49 as well. But traders will buy above 50, stop below 50, betting on an upside breakout. We still have the measured move target above, and we can certainly get up there. But I'm not that interested in just holding long when the market's been going sideways for this long. Here's the euro dollar on the daily chart, and I think it's pretty interesting. I think the close of February 1st is a target, and we came within 20-ish pips. Close here was 99, basically 73, so about 24 pips we came within the range, but I don't think that's close enough. So it'll be interesting to see. I think the market still has to get to this close, so this may have just been a trap, trapping bears into selling, and then the market rallies up to here. breaking above 49, but you can see, looks like there's more sellers above 49 than buyers. It'll be interesting to see the bears that sold below 49 and sold more above it. Will they be able to make money back at the 49 low? In other words, are we going to get back to this line right here, the low of 49? If we do, that will be good for the bears. And this is what makes channels difficult. Don in the Discord asked, on trading range days like these, would you ever consider finding setups on lower time frames, like 1 or 2 minute, and try to catch reversals where 5-minute limit order traders would be taking them? You know, I think the reality is traders trade limit orders all the time. Al, he trades 1-minute charts, 2-minute charts, I believe pretty regularly. But, you know, the problem for most traders trading 1 or 2-minute charts is they will screw it up. And it looks easy. So, you know, this looks pretty simple, but what you have to remember is often these bars form with, 30 seconds left in the bar. It can look completely different. So here is, this bar ends in 3 seconds. Do you buy it? Do you sell it? And, is it 2 legs up? So you buy the close of that bar? Maybe. But, it's not. I think most traders are going to lose. If they cannot trade a 5-minute chart well, I think they will indefinitely lose trading a 2-minute chart. Bears might be giving up once again. Possible wedge. So will the bears do something different here? Will the bulls be able to do something different? Will they be able to close above the 44 high? Or will the bulls get trapped? And will the market sell off? This bar, there's a minute left in the bar, and it could look very different by the time this bar closes. So let's see if the bulls can get a gap. It looks like the bulls are trying to squeeze the bears out, but remember what I said, channels are always trying to get traders to hope that there's going to be a breakout. And until there's a strong breakout with follow through and the gap forms, then this could easily fail. Beginning to look good for the bulls. We still have the target above. Decent bar for the bulls, 3-bar micro channel, 50, 51, 52. Decent bull bar, 52, probably by the close. And, if you buy it, maybe you put your stop below 52, arguing that if this is going to be an upside breakout, the market should not fall below 52. And that's probably true. If this is going to lead to a strong rally, it shouldn't fall below 52. And what we have to remember is this is still a wedge. That's why I drew that line before the bar closed. If this bar closes on its low, which I think it probably will, then I don't know if it'll probably close on its low. A better thing to say would be, I think the market is going to be disappointing for the bulls. In other words, the bulls that buy the close of 52 probably going to be disappointed. So you can see this bar we're a minute into the bar and traders sold it. So why, if everyone was so eager to buy, why is this bar selling off? We went 1 tick above 52 and turned down. Another comment is whenever you look at something and you think that one bar could flip the direction of the always in, so you look at 52, you think it's always in long, but then you see 53 and you think, well, if 53 closes on its low, I don't know, maybe I should get out of longs. Whenever you think that, that's a sign that you might be in a trading range. So you look at 38, you think, maybe it's always in short. And then 39, bull bar closing on its high, and you say, well, I don't know, maybe I'm wrong. maybe it never went always in short. You know, same with 45. You see 45, big bear bar, but then you think 46, you know, you see 45 and you think it's always in short, but then you see a big bear bar, a big bull bar on 46. You think, well, I don't know, maybe it's always in long. Maybe I was wrong. So I am suspicious about 53. Now, if I think the market's going to sell off, why would I buy the close at 52 and put a stop below 52? I would not be interested in buying the close at 52. But if I was going to buy, if I had to buy, I would put a stop probably below 52. And the reason is, I think I don't want to have bad risk reward. The probability is not great. Therefore, I want decent risk reward. So to me, if this is going to rally, it should not fall below 52. And the reality is, we should get a decent close here. It should not be a bear bar closing on its low. The open of the day is an obvious magnet. So the bears that sold below 48, the bears that sold below 49, guess what? They're probably still going to make money. We're probably still going to get back to the open of the day. 52 is the best looking bar in several bars, and it's a possible third leg up, and the third leg to 52 is nested with two legs. So what I mean is we have three pushes, 1, 2, 3, and the third leg is nested, 1, pull back 2. It's also nested in its own wedge. We rallied on 46, sold off on 47, rallied to 49, sold off to 50, and rallied again. The channel up from 46 is tight, but that fact that it's several pushes up and a possible third leg makes it a problem for buying up here. So think about it. If you bought the close at 52, how are you feeling? The market has only gone one tick above the high of 52. Some traders maybe bought more lower, deciding if they should get out. Another good example about waiting for bars to close. This bar has spent the majority of its time somewhere down here, maybe below its midpoint. And with 20 seconds left in the bar, we're back to the open. So what do you do if this bar closes on its high? Well, that's a little bit of a problem for the mentality of saying that this is going to be a bear bar. So if you sold, maybe you front ran the short and then it closes as a bull bar on its high, that's a problem. So to Don McAllister's question about 2-minute charts, this is a 5-minute chart. And in 30 seconds, this bar reversed. So if you think about it, if we pull out a calculator and think about the logic of that for just a second, 30 seconds out of 5 minutes is 10% of the bar. If I did the math right, so 30 seconds, there's 5 minutes, and there's 60 seconds a minute. So 10% in the final 10% of this bar, it reversed. So on a 2-minute chart, it's very possible that you have 120 seconds. In the final 12 seconds of a 2-minute bar, it can sell off and then reverse up quickly. So that is my problem with wanting to trade smaller time frames. I think it can be very dangerous because, again, in the final 10% of the bar, which would be 12 seconds of a 2-minute chart, it can reverse. Now, the bears will see this as a possible double top. The market rallied on 52, sold off on 53, and then rallied again on 53, and it might sell off again. That would be a micro double top. But now we have 4 consecutive bull bars. So the bulls, they want some kind of measuring gap. Measure move, the 44 high, and the current bar low. And by the way, just kind of a side comment. Someone asked Rose about Rose made a comment and someone was asking, how do you get that type of thinking that they wrote in their message? And what they're asking is, in a nutshell, what they're asking is, how do you think back and forth? And one thing, if you pay really close attention now, it's part of the reason people get frustrated, but it's the reality with trading. If you're looking at the market and you're having trouble thinking through both sides of what the bulls and what the bears are doing, then you're probably wrong in your analysis. So in other words, if you think at any given point, if you're very certain that, oh, it's clearly bullish, I should only buy, or it's clearly bearish, I should only sell. If you think that a lot, then your analysis is probably wrong. Most of the time, you should be able to find some logical possible, bear case and bull case. So always remember, as Al says, if the market's going up, there's institutions buying, but there's also institutions that are selling, and they've got, majority of the time, they've got a reasonable argument as to why they're selling. So the bulls are trying to get a bull breakout of a wedge top and bull breakout of a channel, and they want to get up to this high up here, low of 18, high of 24. And they might get it. This might squeeze the bulls. This might squeeze the bears. Well, now we get a bear bar. So still a wedge. And confusing picture, but we have an open gap here. The bulls really need to keep this gap open at the high of 44. Otherwise, if this gap closes, that will further increase the chances this is a leg in a trading range, and we'll probably test back down to this area. So I would not count the bears out yet. They have not given up yet. Bulls selling the 44 high, scaled in, made money. Let's see if the bears that sold the 44 high, scaled in, made money. Let's see if the bears that sell the 50 high or the 51 high and scaled in made money. Bears that sold 51 and sold more during 52, you can see they made money. The market 53 low went below the 51 high. To me, this is disappointing. If I'm buying, I want the market to race up, and if I buy and the market starts to stall in here, I'm going to be thinking more and more about exiting. And the longer this goes sideways at a new high, the less willing traders are going to be, the quicker traders are going to be to start selling, which could drive the market down to here. So to me, it still looks like the odds slightly favor the market failing and the upside breakout not going much higher. I'm trying to open up a tick chart, and for whatever reason it is taking a long time to open. So give me just a second here. So here's the tick chart, and you can see that here's the open of the day. The sell-off got down to about negative 680, never reached negative 700 in ticks, and the rally went above 700 right here. But the point is, it's favoring, obviously it takes more to the upside than the downside. Still, getting down to 300 in here, so it's a little bit weaker. It's basically a small pullback trend. It's a tight channel. It's weaker than a typical small pullback trend. But the point I'm making is sometimes you can look at ticks, and it's an easy way to kind of look. And if you see a rally and you look at this and you see that the pullbacks, are not much below, they're certainly not 700. Maybe they're closer to 300 or 400 or above that, negative 300 or 400 or above it. That is an easy way to kind of measure if the market's in a small pullback trend. This channel up is fairly tight from 46. Bears not making money selling below bars. But if this starts to go sideways, we can easily get back down to the open of the day. So when you look at this channel, once again, bears made money selling anywhere above 44, and they're having the opportunity to exit. Probably go into transition and go sideways fairly soon. If bears continue to make money selling above bars, eventually they will probably start to make money selling below bars. It's important to realize we have a possible open gap. Basically the close of 44. You have to wonder. It's an open gap, and it could lead to a measured move. So we could easily get an upside breakout. The bears really need to close this gap. Otherwise, the risk increases of some kind of measured move. Maybe from the low of 38 to this area, which takes you up to a measured move from the 16 low to the 24 high. So still always in long, and this blue area, this open gap, is a problem for the bulls. The problem for the bears. Bulls trying to break. Let me move the mic. There we go. Bulls trying to break to the upside. So looks like we're going to have to get to the targets above. These days can be frustrating. You get a leg in a trading range that's rather tight, and then you get this open gap, and you quickly get a rally to the upside. So for me, that's why it's really important to be aware when it becomes difficult for bears to make money. And although the odds favor the transition into a trading range, when you have a bull channel, there's always the chance of the opposite. You can also look at higher time frames. So 15-minute charts. Rallied, pulled back, rallied, pulled back, rallied again, sold off. Possible wedge, but this might have reset the count. So first push, pull back, second. And then where's the third? Maybe the third push, but fairly tight channel. You can see it's basically a micro channel from this low to here, and the market's trying to rally. Bulls that bought, scalping out, aggressive bear selling. So let's see how this bar closes. Difficult to stay long if this bar closes on its low. For me, if it is a bear bar closing on its low, I'd probably exit longs. Doji bar, but small body relative to the tail, weakens the probability of selling below 61. So still probably going at least a little bit higher. In bulls, the reason bulls are still willing to buy is because they know that traders can buy and scale in. Traders buy 52, 53, they use a wide stop and they buy more lower. So rallies up to here, probably using a wide stop, and they'll buy more lower. One thing that can be helpful is to look at something like the SDS. The SDS is the inverse of the SPY. Harder to see these days. Another way you can do it is, let me do it like this. So often, I'll do this pretty regularly. I haven't done it in a minute, but let me try it here. So if you're on TradeStation, you can go to, I'm going to make an inverse of this chart. I know NinjaTrader and other platforms, they've got the ability to just reverse the bars. But if I go to Style, and I think I've got to do it like this, where there's outlining enabled, but make an up bar white, down bar, no, I've got that backwards. Make an up bar black, down bar white, make the wicks black, and it'll be, obviously it's the reverse, so it's the wrong direction. Then, what I'll often do is I'll go to something like Snag It, where I'll just take a picture of it. There we go. I'll share my screen in just a second. I'm going to open up a Word document. So here's a Word document. Here's my copy. And you can see this is it's a backwards chart. But what I can do is flip the chart upside down. Then I'm going to drag one of these from left to right. Now, look what we have. We have basically the exact opposite of the day. So we have a strong rally, decent reversal bar. Let's do like this. So bar 16, strong reversal after a sell-off, strong reversal up, and then a sell-off, and then a fairly tight channel. You can see as it's going down, big bull bar, should be buyers below for a second leg, but instead there were sellers. So the market sold off down to here, which is this area right here. And give me just 1 second. I want to see something. So anyways, tight channel, strong bear bar, strong bull bar, and then strong reversal to the upside, strong reversal to the downside. And this one bull bar here is allowing the bears, the bulls that bought a pullback, betting on a second leg, it's allowing them out. So the opposite of that is there's bears that sold higher, or they sold a pullback and they scaled in, and this bar is allowing those bears out. So sometimes that helps just to look at the opposite. And if you look at this chart and say, yeah, the channel down is pretty tight, we're getting open gaps here, and it's hard to make money buying above bars, and that can be a warning that you're in a fairly tight bull channel. And I want to say, one thing about studying as far as Al's material, because I know Rose is talking to someone about what to, let me check the mic really quick. Give me 1 second. I get it though. Speaking of the flipping the chart upside down, one of the TradeStation is a great platform, but it really is behind on quite a few, I guess, modern day things. Because I've heard several people say you can mirror in NinjaTrader, and I know that technically what I did with the screenshot is mirroring, but I think that's valuable. Anyways, one thing I want to mention about how to study Al, I think because Rose is talking about this in the Discord, one of the things one has to do is, the first thing is they've got to spend a long time really watching the course. That's probably the first, best thing one can do. And the other thing is, I think they really need to spend some time, and at least I can speak for what helped me, spending a lot of time listening to Al talk about days, because it taught me to think about both sides of the market and to understand that it's really not all that one-sided. But one really has to spend a long time to understand the information first. I often say it, I think you really have to get to the point where you can give a lecture on one of those videos. So if you had all the PowerPoint slides, could you record a video and give a presentation over it? Or better yet, could you just take those subjects and build your own presentation out of charts? So bull channel, fairly tight. We have another possible negative gap in here, the low of 61 and maybe the close of 54, or the close of 61 and the close of 54. So let me draw that really quick. Someone asked, do I know of anyone that just shorts the market? I don't think, do I know any, there's institutions that would, certain funds, or, the way a certain strategy is designed, but no one institution is just going to short the market. What they might do, and by institutions, I mean banks, hedge funds, trading programs, they're going to have several different strategies. So there might be one algorithm or one division, one trading program that will strictly short and look for things to sell or things that are going bankrupt, various things like that. But as far as what this person's asking, I don't think there's going to be someone out there that's just going to necessarily sell or just short. So bears continuing not to make money below bars, and that is a problem. Open gap, open gap. Whenever you start to see open gaps, it's really important to not be in a hurry to sell. Give me one moment. Another bear bar on $64. For me, I would get out of longs above 64 or below 64. Type bear channel, but probably going to get to the moving average soon. And, I think it's okay to exit below 64 and wait for a couple legs. What about selling below 64? It's probably okay, but I suspect the traders selling below 64 are pretty quick to make decisions, and they're mostly probably going to scalp out. So the bears tested into the gap of this blue area, 58 close, and they couldn't close it. So the market is still in a fairly tight bull channel. Market sold off below 65 and everybody bought it. You'll have some bears who sold below 64, and when 65 went down and started to hesitate, what do? A lot of them started buying back, and bulls would do that as well. Type bull channel, and until the bears get a strong breakout or a strong trend line break, traders will assume everything's minor. April the 4th high is at around 63. It's about 14 points above where we are. So Don in the Discord asked if I would talk more about second leg traps and basically how this morning, what second leg traps did it have? And yeah, Don, give me just a second. I'm going to get a sip of water. But yes, I will talk about it. That's a very, and I've got some slides I'll show on that too. Second leg traps are really important to understand, and they're so common in trading range days. But give me just a minute and I will talk about it. So right now, this is it's happening later than what I expected. But again, this is why I would get out below 64. Channels typically evolve into trading ranges, and they happen pretty quick. And Don, to your point about second leg traps, this could be a second leg trap. It's a tight channel. It probably won't be. But if you think about it, we went down on 65, up on 66, and we're going down again on 67. So on a lower time frame, maybe like a 2-minute chart, it's basically two legs. Leg one, pull back, leg two. And bulls will try and buy and reverse the market up. But anyways, give me just a minute and I will talk more about second leg traps. In the meantime, the bears, they want to close this gap, get back down to this area. We have the open of the day not far away, and that's a logical target. We have the 49 low, which was a reasonable stop entry, a logical target as well. Bears sell below this bar, they scale in higher, that we will probably get back down to this low. So I'm going to mark it as the 49 low. And obviously we've got the open of the day right here. So I will be back in just a few. Roy Rawling in the Discord asked if that's classic channel support. And what they're asking is basically this blue line. Let me get rid of this blue box. They're asking if this is support. And it pretty much is. So let me draw a line. Thought I got rid of that. Is this area support? And the answer is yes. This red line, it's a gap. So here's the look. This gap extends to the right. Bears sold, scaled in, tried to close it on 57, 58, sold off again on 68, tried to close it, and they failed. So yes, that is a gap. And you can argue, is it the start of a channel? Sure. I mean, obviously the larger channel, spike, pullback channel, maybe a spike, pullback channel. But you can also argue a spike, pullback, and then the start of a channel. And 58 is the bottom of a channel. Patterns will have lots of nested patterns within them. So let's talk about second leg traps for just a second. Let me do this. So you can see we sold off to 65, pulled back on 66, sold off again on 68. And that is a version of a second leg or a second leg trap. Leg one, pull back, leg two. So back to Don's question in the Discord. Don asked, can you help me understand second leg traps? And was this morning's trading activity essentially a second leg trap in the opposite direction of the overall trend from yesterday? So the overall trend from yesterday, so what Don is asking is 13, 14, and 15 the second leg trap from the bull trend on the prior day? And basically, yes, it is. And if you look at it, on the open, we had a sell-off that formed a trading range, and the bears tried to get a strong breakout. Whenever the market tries to get a strong breakout on 13, 14, and 15, and it's a second leg, in other words, there's a lot of trading range trading in here and the market breaks to the downside, and that will increase the chances that the market is going to, that this breakout is going to fail. Give me just 1 second. Will increase the chances that the market is going to, that this breakout is going to fail. Give me just 1 second. So when you get a lot of trading range trading, and then you finally get a breakout, always look to the left. And while I'm doing this, I want to pull up some slides. Anyways, back to second leg traps. A second leg trap is, that happen really very frequently. Just here's some kind of basic, I'm trying to make more and more slides just over like every day. And even yesterday, strong sell-off. It's a variant. It's not exactly a second leg trap, but it is in a way. We gapped down, leg one, pulled back, sold off. There's leg two. Whenever you get a strong sell-off and you look to the left and it's a high or low, there's an increased risk of a reversal. This happened in crude oil. This is a 60-minute chart of crude oil. And you can see it's a trading range. Second leg traps are really, really common in trading range days. And if you look at a 60-minute chart on crude oil, we can just pull it up real quick. You can see strong rally today. But here is that area. So we had a really big bar, strong sell-off, but it's a possible second leg trap. Leg one, pull back. Leg two, big bear bar. And what's really common with second leg traps is when the market reverses, it often, if it goes above the top of the second leg, it usually enters a trading range. That's why you'll often hear Al say, let me just try and find one. I'll find one I'm looking for in a minute. But anyways, the point is second leg traps. The easiest way to think about it is whenever the market is having a breakout and you look to the left and you see bars to the left, so you see a sell-off and you look to the left and it's a possible high or low, then that will increase the chances of a second leg trap. And they're really frequent. Second leg trap, I talked about that one. Leg one, pull back, possible second leg trap, not really that easy to see. Here's a second leg trap for the bulls. We were in a tight bear channel, strong breakout, first leg, pull back, and then a strong second leg. And you look at this breakout and you see that and you think, oh, the market's bottoming, we're going higher. But the problem is you just don't know how many traders are waiting to sell. So some traders, they'll see this as the first touch of the moving average in several bars. They will look to sell the close of this bar or the close of the next bar, assuming the next bar is weak. And then we have a weak bar, and then the market sells off. You could argue this is a second leg, leg one, pull back, leg two, and you look to the left, and it's a possible high or low. So the point is, second leg traps typically form in trading ranges, and they're usually kind of the same thing here. It's a variant. It's not really that easy. I get it. I wouldn't necessarily call this a second leg trap, but it's a tight bull channel in a strong sell-off. Strong sell-off, you look to the left, you have to wonder if it's going to possibly be some sort of high or low. And this is pretty common when you're in a really tight channel. So, for example, if we go to like a 30-minute chart, here, strong rally. On a 30-minute chart, this is going to be a pretty minor reversal. So, I know I've got a slide on that. I want to see one thing, but I'll find it in a second. So the market broke to the upside and turned down, starting to form more of a trading range look. We went maybe a tick or two above the 61 high and immediately sold off. That is a sign of trading range price action. Those are some good questions. Give me just a second and I'll talk about it. By the way, with it being, 2:30 in the afternoon, 3:30 Eastern time, most traders better off just waiting. I wouldn't worry about, sure, you might get a downside breakout. I wouldn't worry about it. When it gets to be late in the day, it's typically a better way to say that whenever it's, bar 72, which is basically 2:30, and the market's going sideways for the most part, it's probably going to continue sideways. So I would not worry about missing anything. The great thing about trading is there's always tomorrow. So I would just let this day be. It's been a fairly, tight channel, but lots of trading range price action. Probably going to go sideways. We could sell off to the open of the day, but I would just let it be. Give me just a few on the questions and I'll answer them because there's some really interesting ones. So we might be trying to test the open of the day here and probably going to close the gap, probably get down to the 49 low. Very common in trading ranges to get a late sell-off, and I think of that as kind of relieving the trap traders before the end of the day. But probably better just to let it go. Well, there you go. Now, looks like, what about the bulls and all their hard work over the past couple hours? And the bears just erased it in one bar. That is why a lot of traders are cautious when you get a bull channel. And there's a lot of selling pressure because you can quickly get a fairly sharp sell-off. So I would not be surprised. We're obviously going to get to the open of the day where we're really close to it. I would not be surprised if we get to the 38 close. So trading range, strong enough bar, 74. Now is 74 a second leg trap? Leg 1 to 68, pullback, leg 2 to 74. It might be, but to me, 74 is trapping a lot of bulls into a bad trade, and that automatically will increase the probability of a sell-off. So to me, I think we're going lower. Remember what I said about the 38 bears? The bears that sold the close at 38 never got a chance to get out, break even. So you have to wonder if this sell-off is going to get down there. I know it seems kind of crazy, but trading range days are just really forgiving for traders, especially for traders that use wide stops and scale in. So for me, the next target is the 38 close. Bears sold in here, and in theory, some would scale in. The market should retest this price level. So let me take a look at some questions here. I'm going to wait for the questions about the second leg traps because I was making a PowerPoint slide and I want it to save, and I'll pull it up on this other computer, but it's got to save in the cloud first. But clearly always in short. So let's see here. Jasper asked, at what point do you consider bars too small to trade, i.e. not worth it? Example, ATR, average true range, below 2 on the 5-minute chart. I personally do not pay a lot of attention to ATR, but for me, I'm more of a visual person. I just kind of look at the bars, and there's a couple factors you have to think through. One is, what is your cost of transaction? So in other words, what's your commission? Most traders, if the range is smaller than let me think of a different way. If the bars are really tight and it's hard to make money with stop entries and you're in a tight trading range, most traders should not trade. And, even through here, if you're buying below bars and scaling in, scalping out, that's probably okay. But for me, let me just find a good, like even this is kind of difficult to trade, somewhat difficult. But when there's a lot of overlapping bars, most traders should wait. The good thing about the E-mini or the micros or the SPY, the range is usually big enough where it's not that much of an issue. Like in here, for me, when I look at this, I see this as more of a tight trading range. Therefore, I'm going to be more resistant to be selling too far down, buying too far up, and I'm more likely to want to sell and scale in, buy below bars and scale in lower. But to me, I don't really give ATR that much attention. But I know plenty of people use it and they'll adjust their scalps based on what the ATR is. For me, I just kind of look at the bars. But I'm also pretty prone to, sell on the way down, scalp out, sell again, scalp out. So I'm more willing to get in multiple times rather than once. But I hope that answers your question, Jasper. Simply Joe asks, do you typically see a smaller range on the day before a typically larger range day, like the CPI report? I don't know. I mean, for me, there's a few things. One, it's context. One, daily chart. We have two big bull bars, and I believe I said on the blog that I thought the bulls would be disappointed within a day or two. And the reason I thought that is we're in trading range. Bulls buy up here, they scale in lower, and it does something kind of frustrating. That happens all the time. Let's find some examples. Let's see. You buy up here, you buy lower, kind of starts to stall. The other point is, I think, two things. As far as, let me back up about your question. As far as CPI reports go, I really think of the day more or less as what's the daily chart doing. And the daily chart can give you some hints, but for me, I place more than 90% of my thought process into the chart in front of me. It's great and fun to think about the daily chart and what all the daily chart can do. But, even on the blogs, if I say that the daily chart, we're probably going to go sideways to up for a few days or sideways to down for a few days. If we're looking at a 5-minute chart, what matters is the 5-minute chart, not the daily chart. By the way, someone asked about trading 2-minute charts and whether that's a reasonable thing to do. And I made the comment that in the last, 10% of the bar, it can drastically look different. And the reason I'm bringing that up is there's 81 bars in a 5-minute chart on the day session. And if you think about it, 10% is, or 90% of the day is about bar 72. So if you think about this example, here is bar 1, right here. Here's the low of bar 1. So this day, I keep hitting the wrong key to do this. This is the low of the day, this red line. So let me see here. I'm mainly typing this to illustrate a point. Here's the low of the day. And if we were to sell off, if we closed below the low of the day, in essence, the day would have completely reversed in the last 10% of the day's range, in the 10% of the day. And I made the comment about that because when you're trading a smaller time frame, the market can quickly do something different in the final 10% of the bar, 20% of the bar. So just because a day, that's what's difficult about daily charts, and with really any bar, is if this day closes on its low, in essence, what happened is we rallied for the first 70 bars, 72 bars, and in the final 8 or 9 bars, we completely reversed the rally. So that's kind of more of a fun food for thought. How do you apply that and use it in your trading? You use it by understanding that whenever a bar is, it's really good to wait for bars to close, because they can change and look drastically different by the time the bar closes. So that's kind of my point with that. So you can see, why are we going down? Who cares? I mean, the market is clearly selling off. Tight channel, or we have a bear channel, we have a bull channel, and lots of selling pressure. And this whole way up, I was saying it looks like a leg in a trading range, looks like a leg in a trading range. And, I know I seem like an idiot because I keep talking about the bears and how the rally up is weak, and, it's probably going to test the downside. I didn't expect this, but these kind of rallies, for the most part, are unsustainable. So strong sell-off at yesterday's low, probably going to pull back here. Since we're on the topic of second leg traps, well, it's kind of hard to read that. Let's use this. I'm going to make it black and white just for ease. So we have here's a 15-minute chart, strong rally. Consecutive bear bars, probably going to go lower, strong enough for a second leg. But what traders do not know is if this sells off and starts to stall, maybe get 2 or 3 legs down, this could be a higher low. But for the the bears, they want this to be the start of a second leg trap. Leg 1, pull back, leg 2. So to everybody's question about second leg traps, here's a 60-minute chart. We rallied up to here, we pulled back, we're getting another rally, and you never know. Whenever you look and you see bars to the left, you never know how many traders are waiting to sell aggressively. And you can see several consecutive buy climaxes, everybody started selling. So do you buy here? I would not. This is fairly strong, and we may get to the 16 low. I don't know if we'll get there today. That's a pretty strong sell-off and not all that much time left in the day. So I think that's going to be hard for that to happen. Dawn asked in the Discord, they said they were in and out all morning, but they caught Al giving the odds of today's price action at 20%, continued trend from the prior day. I think it was nothing typical. You will get sideways to down following the buy climax. Does that sound right? Yeah, I think what Al was saying is, kind of back up, Al was probably saying 20% chance today was going to be another strong trend day. Rallied, pulled back, strong buy climax into yesterday. So you could argue, expect 2 hours of sideways trading at a minimum, and a lot of trading range trading today. Strong rally, lots of sideways, another rally, lots of sideways. Reasonable to expect that, and then a lot of sideways on the open. I don't think, I didn't expect this strong of a rally, at least for it to last this long. And I didn't expect this strong of a sell-off. But to me, this will increase the chances of some kind of second leg down. You will have bulls who bought the 38 close or the 38 low as the market was going down, anticipating that there's disappointed bears. So bears sell, they get trapped, or they sell and take a loss, And the bulls know that the bears are probably not going to be interested in buying again at this price level. So what do? The bulls buy with limit orders at this blue line or a little bit lower, and they get trapped on 76. They scale in lower here. And some of those bulls are getting out break even right there. Others might hold and say, yeah, we'll probably get back to the blue line. Fairly dangerous to do that whenever you get a route sell-off that's this strong. We may get back down to the open of the month. I don't know why I said today's low is right there. It's obviously here. I don't know why I was thinking about bar 1. So today's low is all the way down here. And I still don't think we're going to get down there. We might. But to me, that is pretty far. I think the better argument for the bears is the midpoint of the day, which is somewhere around, let's just call it 41.40. So 41.40 is the midpoint of the day. That is going to be an important price level. I'm not going to draw it just because I've already got so many lines on the chart, and I don't think it's relevant right now. I'm going to see one thing really quick. Back to the open of the month. We can get down to today's low. We're really not that far away from it. I'm turning the screen off and I'm trying to pull something up. I'm going to go ahead and open the question box. So that way people have time to ask any questions they want. So this is what I was trying to show. I just made a quick slide of it. This is that sell-off on April the 3rd of 2023. And we rallied, formed basically a parabolic wedge at the top. And not really great shape, but it's close enough. And, or you could say parabolic wedge here, here, and here. And we made a very strong sell-off. But when you look at that sell-off, you always have to wonder if it's a possible higher low in some form of a trap type bull channel for the past couple of days here. And this sell-off was just a test of the 15-minute moving average, which would be somewhere around here. And the market went sideways to up. Whenever you get a doji like 77 after a sell to close market, sell to close 74, 75, 76, most sell to close sell-offs do not last that many bars, maybe 5 bars, 6 bars, but rarely a lot more than that. These dojis are kind of red lights. They should be like flashing red lights in your mind, because a lot of traders, it's a warning that the sell to close market, sorry, those are really loud. It's a warning that the sell to close market will probably not go on all that much lower. So aside from time and it being the close of the U.S. markets other than the futures market, whenever you see this, whenever you see 77, a lot of traders look to scalp out. I'm going to fix one thing really quick. If there's any questions, feel free to ask them in the Discord or the webinar. If you're in the webinar, it'd be easier if you ask them in the webinar because it's easier to track those, but you feel free to ask them either way. I need to change the sound settings on my computer really quick. There we go. I had earphones in and the closing bell was extremely loud in my ear, so I want to turn this off on my computer really quick. Okay, I've got it. That was not really that pleasant of a sound. You can see there were a lot of buyers at the open of the month. Here was the open of the month, sold off, basically touched it, reversed up pretty quick. And you can see any of the bulls that bought the 38 close, 38 low, they made money. They bought, they scaled in, they made money over here. One thing, before I talk about the end of the day, one thing I think that's really important to think about is, there we go. I think it's really important to think like an institution. I know that sounds really simple, but what I mean by that is I think a lot of people, it's easy to get caught up in viewing the market from the standpoint of yourself. In other words, if I'm trying to learn how to trade, I've only got so much capital to trade with, therefore I can't scale in. I'm stuck with one contract. One of the problems because we've all been there, is it's easy to get caught up in thinking the way you want to trade or, your own circumstances. So an easy example, people do it all the time. I'm going to risk more on a trade because I have to. And that's the exact opposite of what institutions are doing. Or I'm going to scale in when I probably shouldn't. So a lot of traders, what I'm getting at is you have to be able to think. I think it's really good practice to take pictures of charts. And I like doing this, for one, because it forces you to think about markets and think about, concepts and save it. But also, it also forces me to just look at a chart and think about it and forget. I make a little note at the bottom. Sometimes I'll put it at the bottom of the screen. And really the note's there just so maybe I find something interesting and I want to look at the chart further. But one of the things that's helpful about it is to just forget the time frame, forget the bar. This could be a daily chart. This could be a 60-minute chart. Who cares? And just think about the bars. Over here, big rally, big sell-off. Forget the fact that it's the, dollar-yen 60-minute chart. And really just start thinking, what are traders doing? And that forces you to start thinking more like an institution. What are the institutions doing here? What are limit order traders doing? What are stop order traders doing? Because I think you have to get out of the mentality of trade, viewing the market from the lens of the way you want to trade, or maybe your circumstances, rather than what you should do. So I hope that makes sense. An easy example is if I'm selling here and my stop's up here and I know the risk is really big, the reality is institutions are trading smaller. They're trading smaller and allowing themselves to scale in. If you can't do that, don't take that trade. Jacob Vincent in Discord asked, to follow up on the second leg discussion, what distinguishes the trap from bears just scalping out after 21 ticks from this 63 high? Let's look at the 63 high. So to follow up on the second leg trap discussion, what distinguishes the trap from bears just scalping out after 21 ticks from the 63 high. Okay, yeah, I think you mean, so for bears, what distinguishes 2 legs down, second leg trap, 68? What's the difference between this being a second leg trap and bears just scalping out after 21 ticks from up here, or 4 points, whatever you want to call it? I think the biggest, I mean, it's kind of the same. A second leg trap is both, it's bears, it's bulls buying and bears buying back shorts. So kind of looks crazy, but big sell-off, look to the left. This might be a trap. It's probably not going to be a trap, but it could be leg 1, pull back, leg 2. Obviously, down here, bears are buying back shorts and bulls are buying, and they're probably scalping. The biggest thing with second leg traps to understand is second leg traps are typically trading range bars. And what that means is they typically lead to trading range price action. So a second leg trap and a climactic bar are kind of the same thing. You have a buy climax and a pullback. We went below the buy climax, but the market went sideways. Buy climax bar, pullback, sideways. So I hope that answers your question. Yes, Judith, and they put in the Discord from their notes about Al, after a buy climax, 75% chance of sideways to down, 25% chance of another strong trend day. They're absolutely correct. The only piece I would add to that, which I'm sure they already know this, is 75% chance of sideways for at least beginning before the end of the second hour. But they are spot on. Focus Trade asks, when you look to see where the market is going, what do you look for? The closest gaps, swing lows, highs of the bars, anything else? Can you give examples? Yeah, and that's not really an easy answer. You know, it really depends on the day. But, you know, the first thing I'm always looking for, and I'd really like to make maybe a video on this down the road. And, you know, the first thing I think about is the opening range, the first 6 bars, the first 12 bars. The reason why on the blogs, on the pre-market, I often say wait for the first 6 to 12 bars is the first 6 to 12 bars give you an incredible amount of information. Like this right here, bar 1 to 16, even the first 16 bars, lots of trading range price action. That will increase the chances that the day is going to be a trading range. We had so much trading range price action for here, first 24 bars, that the market rallied and it had to get back to it. But anyways, the first thing I look for, you know, I'm trying to think through what would I tell you to write down on a pen and paper. What I would say is the day going to be a trend from the open day or a trading range? And I say that because that typically, let's find some examples. You want situations where traders get trapped. So if it's a trend from the open, like here, bears get trapped selling anywhere. There's no strong counter trend moves. There's just a strong bull bar and a subtle rally. The other type of day you often get is some sort of overlap. Trend from the open, but 60% chance it evolves into a trading range. Same thing here, except this day it went sideways for a few hours and then went higher. The other thing I look for sell-off or a rally on the open, and I expect 50% chance that you're going to get a reversal of that move. Sell-off, 50% chance of reversal. But there's one important piece here that I also look for. Whenever you get a strong move, up or down, I often think it's either going to be a trend or a trading range. And what that means is, that means that even if we go above these highs, there's probably sellers above. There's probably sellers above, and the market's going to go sideways. So here, we have a rally, strong bear bar. and follow through. Probably at least going to be some kind of bear trend or trading range for a little while. And then we had this strong, we had to basically sell off for the first 18 bars down to 10 o'clock Central Time. Probably a trading range or a bear trend, because for it to be truly a strong bull trend, we would have to get far above the highs. So the first thing I look for is really the opening. What is the open going to do? I prefer limit order traders and scalping. Therefore, I'm really not the biggest fan of a trend from the open on bar one. I like, breakouts that are strong. So this isn't ideal, but I like when you see consecutive strong bull bars. What's not ideal about this situation is it's a wedge, 1, 2, and then 3. So it makes it harder to stay long here. That's what I would start with. So I think most traders, if I'm studying the video course and trying to figure out what's the best way to trade, the first thing I'm doing is really studying the video course and getting a good grasp on it. The second thing I'm doing is asking myself, how would I trade the opening range? So I often say, what I would look for is try to find a swing trade on the open. You pick the number, 80% chance, 90% chance that the market is going to have an opening swing, and it typically begins in the form of a double top, double bottom, wedge top, or a wedge bottom. And I'm going to pull up this chart. I know most of us have seen it 1,000 times, but it's really important. It begins in the form of a double top, double bottom, wedge top, or a wedge bottom. And I'm going to pull up this chart. I know most of us have seen it 1,000 times, but it's really important. Let me just try this one more time. Anyways, I'm having trouble getting into the encyclopedia, but it's the gap up and 4 common outcomes: double tops, double bottoms, wedge tops, wedge bottoms. And while I'm waiting for this to load, someone asked, how they're supposed to ask questions in the webinar. And you can do it in the Discord. Sometimes it's just easier to get missed, but it's fine to do it in Discord. There's also an option in the GoToWebinar, but either one is fine. So let me see if this is loaded yet. It is not, so I'll come back to it. But anyways, it's really common to get a double top or double bottom, or a wedge top or a wedge bottom on the open. That typically leads to a reasonable swing. Someone asked, how much time do you need to change your mind from always in long to always in short? The time required to change your mind from always in long to always in short depends on, is the reversal a minor reversal or a major reversal, which really what that means is the market clearly in a trading range or clearly in a trend? There's really a trend in a trading range. There's only 2 types of markets. It's trending market or trading range market. Some call it, you can call that a, strong momentum market and a mean reversion market. And the point with saying that is the stronger the momentum, then the more difficult it's going to be to reverse the trend. The weaker the momentum, the easier it is to reverse the trend. You heard me mention it today. I said that when typically in a trading range or a channel, which they're pretty much the same thing, a channel is kind of the first leg of a developing trading range. So this is the first leg of the trading range, and then we sold off making the trading range. That's why Al says you typically get a spike, pullback, that leads to a channel, and the channel evolves into a trading range. But anyways, in a channel, whenever the market clearly becomes always in long, 21, 22, 23, you get a deep pullback. Whenever you look at a bar, same with 34, 33, big bull bar, but then it sells off. It might be always in long, and then in the final seconds, the bar sells off, and you get a deep pullback. During the pullback phase, you often get a strong bar like 38, and you look at it and you think, gee, maybe this is shifting, maybe it's always in short, but the bears need one more bar, and then the market reverses. Strong trends like 37 and 38, it's going to take a lot of bars and a lot of sideways to reverse the damage. That's why on the daily chart I said quite a few times that the market's breaking out to the upside. We're at resistance, these lows. It's usually whenever the market tests resistance but doesn't break far above it before it pulls back. So we tested into this area, the February 10th low, broke above it but pulled back, and we didn't break above all of this, and we're starting to go sideways. The channel up is so tight that the market, the downside's probably limited. But the one thing I'm saying on the blogs, and it's the one thing I'm going to continue to say, is the more trading range trading we get, the more bear bars that form, the greater the risk of a deep pullback. So the more sideways we go, the more traders are going to start selling, bulls selling out of longs, bears selling to go short, betting that this gap closes. A great example is really today. We rallied for several bars, and the bears tried to reverse the market, tried again. The channel up's tight, but the more bear bars that get added, the more reversal attempts that get added to the rally, eventually there's going to be one that works, and then the market reverses. But as far as time needed to reverse the market, for me, I view it as kind of legs. If the market's in a trading range and there's clearly two legs down at what could be the bottom of the range in a reasonable buy signal bar, I think it's dangerous to stay short. So for me, if I'm selling the 15 close, stop anywhere up here, and then there's a bull bar, I would get out of shorts. And the reason is there's no longer a 60% chance that the market is going to go a lot lower. So selling the close, stop up here. It might be 60%, but then you see this, it's clearly not 60%. You have to get out. But that, I hope that makes sense, and I'll talk more about that sometime soon. How would one scale in during the strong sell-off? Well, traders start selling closes. The most important piece to practice is to just sell. That's why I think it's really, really important to be able to trade small. Trade a position where you're just not affected. The SPY would be great because you could truly trade something where you just don't care. But you see the market going down and you say, oh, this momentum looks pretty good. I'm just going to sell the close. So for me, sell the close or sell as it's going down, put your stop up there and just wait. And a lot of traders, what they'll do, they'll trade small enough where they can sell. If it pulls back, they'll sell. They give themselves flexibility. They'll sell, then they'll sell. And, they might sell here, but you have a big bear bar and then a smaller breakout bar and a bigger bear breakout, probably going to pull back soon. So anyways, daily chart. Doji day, probably going to go more sideways and continue to disappoint bulls and the bears. The bears have a second entry short, but following two bull bars closing on their highs, today's bar is a rather weak stop entry short, probably buyers below scaling and lower. So probably going to go at least a little bit higher, though we may have a deep pullback first. So confusing picture, probably going to go sideways. Someone asked, what do I think is going to happen in the Globex session? Let's take a look. You know, the obvious is a second leg down from this. And so for me, here's a 30-minute chart. Here's the overnight hours, kind of the open of, here's the lows of yesterday, strong breakout and deep pullback. And it's basically kind of an expanding triangle, something like that. But you have a big bear bar. When I look at that bar, I think, you know, gee, that's a surprise. It shouldn't have happened. It's probably going to get a second leg down. So we're selling off and we're pulling back. So if I go to like a 15-minute chart, running like a 5-minute chart, big bar, big sell-off, we're probably going to pull back. But, you know, what you have to wonder is, big bar, we could easily get a fairly deep pullback. The deeper this pullback goes, the more sideways it's going to be. Do I think that we're going to get a big sell-off down to here? Probably not. But I wouldn't be surprised if we get some kind of weak bar. 5 minutes left until this bar closes. So I think we'll go down to here. And overnight session, we'll probably get a small second leg down, but you're still within a trading range. And we could easily sell off, pull back, sell off, bottom, and just go more sideways. If the bears are lucky, maybe we get a big bear breakout down to here and sell off, but that probably won't happen. To answer, I misread someone's question, but they were asking about the strong sell-off at the end of the day. And their follow-up question was, they said, my profit fills a spoon and my losses fill a bucket. I am getting better but still losing more than I should, even though it's money that will not affect my life. How do you manage to control this in case you had the same problem as me? Everybody's had the same problem as you. You know, that is welcome to trading. Trading's kind of, you know, you have to learn from experience. You can, that's why I think, you know, I really think everybody should be obligated to really spend, you know, again, I can only speak what worked for me, what, you know, I feel like was beneficial to me. Everybody should be forced to like watch a year's worth of Al's trading room recordings on top of the trading room, because what you learn from Al, at least what I learned from Al, was, and I was on top of that, I was reading the books, watching the videos, but what I learned during the day watching him trade was he truly just is not phased. I remember he did something, I can't remember what it was, but he bought a breakout and scaled in, and got stopped out at the low. And, you know, basically he chimed in making a comment that he took a bigger loss than he normally does, and, you know, basically said, well, now he's got to get to work and make the money back. But he pretty much just shrugged it off like, you know, who cares? And that takes a long time. I also heard this in Orlando, and I thought it was really interesting. Those of you that were in Orlando, you heard this comment. But one thing Al said was he'll typically trade aggressive on, you know, I say that he'll take a lot of trades on the open, and then he'll take a break and then trade, you know, later on in the day. But he's watching the market all day, you know, during the day. But anyways, he will if he takes a loss on the open, he made a comment how sometimes he'll take a loss and then the market starts to go sideways. So he starts trading, you know, aggressively with limit orders, buying below bars, selling above bars, until he makes up the loss and gets back to the profit he wants. And what I thought was interesting about that, kind of funny, is that is because of his ability to trade. He can do that. But to answer your question, how do you stop caring about losing? I see what helps me even to this day is whenever I do something dumb. I talked about yesterday, I took a Forex trade and I didn't realize my stop was closer than it was. And anyways, because of the the bid-ask spread that increases around the close. I was holding like for a 4-hour chart. I got stopped out very quickly, and it took a bigger loss than usual because of the spread. And it was a dumb, it was careless on my part, but I made a PowerPoint slide of it to remind myself, hey, don't forget that at 3 or 4 o'clock, the bid-ask spread increases. So if you're trading a higher time frame, you need to account for that. Anyways, the point with that is you're going to make mistakes, shrug it off, and the key is learning from those mistakes. Can you learn how to fix those mistakes? And you're not going to fix every mistake all at once. It just takes time. But the more you trade, the more you study, the more you think about trading, the less and less mistakes you'll make. And eventually it gets a little bit easier each day. So for me, I try and remember that when I do make mistakes, that's one step closer to being that much better as a trader. All right, so I'm going to talk about the day session now. But yes, you really cannot care. I mean, you have to find a way to not care, and that's also why I talk about an institution. If I am a trader at Goldman Sachs or Bank of America or any hedge fund, I have to think about, I wouldn't care. And you have to find a way to think like an institution would think. Remember, you're competing against institutions. You're competing against computer algorithms, quant traders, and the reality is you're competing against traders that are not emotional, and you have to find a way to compete in the same way. So bar 1, big bear bar, closing above its midpoint. It's a big bar, and to the person's question that asked about, what do I look for in the day? On bar 1, I look at the size of the bar. If it's a big bar, a trading range bar, a bar that's maybe bigger than usual, to me, I expect it's gonna lead to confusion. So probably buyers below, sellers above. Bar 2, an inside bar. An inside bar is a triangle, which means the market is contracting, increases the chances that any breakout up or down will probably be limited. One moment. And in bar 3, bear bar, but failed. It broke below 2, broke below 1, failed to close below 2. So a sign of weakness. Possible micro double bottom, so there might be more buyers below the 2 low or the 1 low. But to me, this looks like a leg in the trading range. We had a tight trading range down here, big bull bar, follow through. We may have to get back in this area here. 4, tried to break above 3, but it could not close above it. 3-bar micro channel, probably sellers above and going at least a little bit sideways. Bar 5, bear bar, but could not close below the 3 low, or, well, it couldn't close below 3, and it could not go below 3 as well. So when you're looking at breakouts, a breakout can close below the low of the prior bar, or it can go below the low of the prior bar. It's good that 3 went below 2 and below 1. It's bad that 3 did not close below 2 and close below 1. So now, up until 3, we were trending. We were getting a high, lower high, and we were getting, a low, well, not really low, but a low on 3. Now, what we're getting is more and more sideways. Yeah, Roy Rawling, I think that's good. And, I think it's important to make notes of bad trades. I try and be lighthearted when I say bad trades. I'm more kind of sarcastic. I think it's important when you look at a trade and say, that was stupid, and you give yourself kind of a little bit of, don't beat yourself up too much. But I think it's good to keep track of, trades and categorize them, because that's how you learn. Anyways, bar 6, going a little bit lower, but possibly 2 legs down. Bulls making money buying below anything, and that is a sign that the market is probably not going to go all that much lower. 7, an inside bar. Really confusing picture. It's a tight bear channel, but to me, that will increase the chances of sellers above. But bulls are making money buying below bars, which is not ideal. 8, a bull bar. Bears sold the close of 6, disappointed 7. So what do they do on 8? Well, look at the close. Look at the low of 8 and the close of 6. Bears sold the close, disappointed 7. They're getting out break even. 9 is a bear bar, and it's reversing 7 and 8. For the bears, it's a low 1 short below 8, but 8 is a bull bar. Probably not going all that much lower. Probably buyers below 8, buyers below 7, scaling in. Some bulls that bought the 8 close, disappointed on 9, they will scale in lower and look to probably exit back at their close. 1 second. And this is common in trading range. You know, if you're buying the close of 8, it's reasonable to put a stop below 7 if you think the market's in a trend. But if the market's in a trading range, the market may trigger the buy. Traders, in other words, traders buy the close of 8 and they buy more at the 7 low. So it's not really all that ideal to exit along at the 7 low. And that's what happened on 10. Bulls buy the close, they buy more at 7. And then what did this bar do when it went to 41.36? You had bulls buy, they bought more lower. Some of them got out break even in here. Other traders, they said, yeah, whatever, it's trading range. We're going to get back to the 8 close. I'll buy and scale in. And that's what happened here. So what about buying above 11? You can, but you're buying somewhat high in a tight trading range. The market's forming some form of a trading range, a lot of overlapping bars. Bears and bulls trading with limit orders, buying below bars, selling above bars, are clearly making money. So what do you think the bears are going to do? Do you think the bears are going to make money if they sell above 10 and scale in? Of course they are, because we're probably in a trading range. 11 and 12, good for the bulls. Probably going at least a little bit higher, but it might also be some form of a trap. We rallied up to 9, and then we reversed on 9, and 10, we rallied up to 12. So it's basically 2 legs. Leg 1, pull back, leg 2. Testing the open of the day, and then 13 is a big bear bar. Surprise bar on 13 may get a small second leg down, so it's reasonable for traders to exit as 13 is going down. Other traders, they'll look at this and they'll say, yeah, we might fall below 10, but we probably won't fall a measured move down. So I'll buy here and buy more lower. And if we get follow through below 10, maybe I'll exit. Surprise bar 14, but couldn't close below 10. And then we get another bar on 15. So what about exiting based on the fact that it's 2 consecutive bear bars? Well, you could, but you have to think about the tails. 14 sold off, and then it rallied into the close. And then 15 rallied as well. So basically we went down and then up, and now we're going down again. So this might form some kind of a micro double bottom. And then the bears got an even bigger sell-off and then a pullback. At this point, it might have been sell to close 14, but 15, it might have been sell to close 15, but 16 is a reversal bar. Probably buyers above and buyers below, scaling in lower, so we may not go all that much lower. If I'm a bear, I'm exiting above 16. 17, low 1 short, probably buyers below. Bears that bought the 15 close probably will be interested in getting out break even. So the markets went, traders sell this close, disappointed 16. And what did they do on 18? They got out at the original close, the close of 15, and the market turned up. Now we triggered a buy, we triggered a sell below 17, and we triggered another sell below, well, we didn't actually, I thought we did. We're trying to trigger a sell below 19 and 20, so it's a low 2 short. It's 2 legs, it's 2-legged pullback. We went down, rallied, pulled back, rallied. We're trying to trigger a second entry, but it's following 2 bull bars. Do you really want to be selling following 2 bull bars? Probably not. so probably buyers below 20. Whenever you get a second leg or a low two-legged pullback at what is probably the bottom of a trading range, then that generally will limit the downside. You often get second leg traps, not second leg traps. You often get low twos at the bottom of trading ranges that fail. It's also common whenever you get a strong buy signal bar like this, it's really common to get some form of a low two short that forces traders to think and question if they should exit the trade. Kind of like below 21, even though 20 and 19 are not great stop entry shorts, some traders may exit below 20, and if they did, it's a weak thing to do. You often hear Al talk about, weak bulls, weak bears. The weak bulls will exit shorts. They'll sell below 21 or 20. A lot of the bulls, the bulls that are buying, I think a lot of them are buying and using wide stops. They're not going to exit below 20. So that's partially why traders bought here. 21, 22, a little bit of a surprise. It was reasonable to buy the close of 12. So what did I say about traders down here? I said traders will buy and buy more lower. So what are they probably going to do up here? They're going to sell. You had some bulls bought during 5 or during 4 as the market went up, and they got trapped as 4 went down. So what are they doing here? Some of those bulls are selling up here, and more bulls are selling up here. So the market's rallying. We've gotten to the high of 12. At this point, is it always in long? It probably is. But remember what I said about always in long and always in short. Whenever you're in what could be a trading range or a channel, it is common for the market to become always in long and then the market reverses. So when I see what could be a two legs, leg 1, pullback, leg 2, and you get a big bar, climactic bar, this bar is the best looking bar out of ever since, 16. There's virtually no tail below, small tail above. That will increase the chances that traders will use it to take profits. And then 24 is a bear bar. So to me, this is a possible second leg trap. When I look to the left, it's a possible lower high with 1. Reasonable to exit below 24 and buy again if the next bar is a bull bar. 24 consecutive bear bars, weaker body on 25, but since it's consecutive bear bars, there might be more sellers above and probably a small second leg down. And then 26, strong sell-off and a deep pullback. So the market broke to the downside on 24, went sideways on 25, so it's a smaller body, and then it got another breakout on 26 that reversed. So it's kind of 2 legs down on a smaller time frame. You'll have bulls buying in this area, betting on a 50% pullback. They buy, stop down here, basically risking 1-to-1, betting we get up to here. And the market it found sellers above 26 and tried to reverse down. But what happened to the bears that sold during 26? Well, they were disappointed by the rally on 26. So a lot of those bears who sold down here, they will use any sell-off to try and buy back shorts. The bulls know that, so the bulls are probably going to buy down here as well, and that's why the market went outside up. 28, a little bit of a surprise, micro double bottom, always in bears. I would certainly exit above 28. What about buying above 28? Buying above 28, it's a low probability buy. You're buying in what's basically the middle of the triangle. You have lows down here, you have a high, and then a lower high here. Reasonable to buy. And if you do, you put your stop below 28, and some traders will be quick to exit if it doesn't race up. Others will just wait for the bar to close. Weak bar on 29. It's arguably a pullback. Breakout on 28, pullback on 29, second leg up. Some bulls will be disappointed. They'll just look to get out, break even, or around their entry price. And then market went outside up on 30. And then 31, a bull bar, but barely closed above 30, went above 24. Good for the bulls. and it's a second leg up from the rally 21, 22, 23. By the way, one thing I want to point out about second leg traps is second leg traps, it's really common to get situations like this. We had a second leg trap yesterday where you have a trading range and then you have a strong rally and a very deep pullback. Whenever you get a second leg trap, it's very common for the market to come close to the lows, maybe sometimes fall below it, but then go sideways. So it's not all that ideal. You can sell the close of 18, but it's really not great. It's the same thing with today, the price level I was just talking about over here. Where was it? Right here. So rally, pullback, strong second leg, deep pullback. Typically when you get a second leg trap, leg one, pullback, leg two, you'll get a deep pullback and the market evolves into a trading range. So the bulls that buy and scale in, you know they're probably going to make money. So that is just important. That's an important thing to remember. I want to make a note of one thing really quick. 1 second. Okay. Thanks for everyone for being patient really quick. Just had to jot a reminder down. So anyways, go back to where we were. Whenever you get second leg traps, one thing I would definitely write down is this is leg one, pullback leg two. So you can argue this is a second leg trap. Second leg traps lead to trading ranges more often than anything else. Therefore, even if we get a sell-off, probably sideways, leg one, pullback, leg two, second leg traps typically lead to trading ranges. So if you are buying up here, you're buying in an area that may just lead to sideways trading. Second leg trap to the upside, leg one, pullback, leg two. So remember what I've been saying, second legs lead to sideways. So if you're selling the reversal down, it's probably going to lead to a trading range. So bulls buying, scaling in lower. Weak second leg up, looks like a trading range. You know you're going to get a breakout up or down. High one buy on 32, probably sellers above, but very tight channel, getting difficult to make money as a bear. Bears sell, they can't really scale in and make money. They sell here, scale in, they really kind of break even. So whenever you start to get a tight channel, and now you have a possible parabolic wedge. You have a tight channel here, parabolic wedge, first push went below the low, second push below the low, third push, and the third push is a big buy climax bar. Whenever you get a tight channel that's parabolic, it typically leads to a minor reversal. Since you have a wedge, and it's a parabolic wedge, 1, 2, 3, expect 2 legs down. But 2 legs in a channel that, a two-legged pullback in a channel that has been lasting 4, 5, 6 bars is probably, it may not last that long. So it might just be 2 or 3 legs down. Bear bar 34. Bears made money, selling 32, scaling in, and then almost outside down 35, and then a sell-off and a pullback on 36. So this might be the two-legged pullback from the parabolic wedge. 1, 2, 3. We went down to 34, up on 35, down on 36. So that is 2 legs, even though it's 3 bars. Second entry short, 37. Some bulls buy above 36. And they would get out maybe below the 37 low. And then a strong bear bar, 38. 38, a little bit of a surprise, probably going at least a little bit lower. Testing the moving average, we found buyers here. We may find buyers here. And the problem the bears face, is this might be a second leg trap, leg one, pullback, leg two. So there might be more buyers down here than sellers, but to me, I think 38, there's probably sellers above 38 or 39 if it's a bull bar. 39, bull bar, closing on its high, possible two-legged trap. So if I'm a bear, if I sold to close at 38, it's probably better to exit above the 39 high, some traders will sell and scale in, and they'll look to get out break even on any pullback. So they sell in here, scale in higher, get out break even on any pullback. Then you get a bull bar of 40, and then 41, an even bigger bull bar. And obviously traders start buying back shorts. And the market tries to pull back on 42 and 43, but it's not giving the bears anything. And then 44, a big bull bar, a little bit of a surprise, breaking out above all the bars to the left, but a weak bar, big tail above, that will increase the probability of more sideways trading. And then 45, strong bear bar, testing the 39 high. It's a little bit of a surprise on 45, so you expect a second leg down. We tried to break above the 1 high and got a deep pullback on 38. We tried to break above the 1 high and the March high on 44, getting a deep pullback. 46, somewhat of a second entry buy, or you can just call it a pullback and a high 1 buy from the 44 high. New high, pullback, high 1 above 46. 47, an inside bar, and then 48, a bull bar, 49, a bear bar. So the market is alternating every few bars and reversing. That is a sign of more and more trading range price action. What about selling below 49? It's reasonable. You can take the sell, but it's selling below a 5-bar micro channel, and it's selling right at the moving average, where a lot of traders are probably going to look to buy. Let's see one thing real quick. 50, bull reversal bar, and then 51, another bull bar, 52, an even bigger bull bar. 52, a little bit of a surprise. It's another wedge, up on 46, down on 47, up on 49, down on 50, and then up on 52. 3 pushes up, 33, 44, and 52. So probably going to have at least a couple legs of a pullback, but the channel's getting tight. The bears are not making money, and that is a warning that something's not right. 53, bears tried to form a wedge, but instead 53 is the bull bar, and a follow-through bar might be by the close and going a little bit higher. But if you are buying up here, if I'm buying the 53 close at the top of the channel, I really want to see the market break to the upside rather quickly, or else I would be pretty quick to exit. 54, doji, 55, another doji, and then 56, another doji. So to me, this looks like more of a leg in a trading range. I'm going to kind of speed it up just a little bit. But then we form this open gap, the 56 close and the 44 close. Open gap here, probably going to go at least a little bit higher. And we try to go up once, pulled back, try to go up second, pulled back, try to go up third time. 64, at this point, the bulls are trying to get up, go higher, and there's just so many reversal attempts. Reversal here, here, second entry short 64, maybe a wedge. 58, pull back on 59, 60, 61, pull back on 61, and then 62 and 63, and then a pullback 63, 64. I would get out of longs below 64 and wait for a few legs down. Two-legged pullback to 68 might be a second leg trap, but below the moving average, we haven't been below the moving average since over here. There's going to be traders buying it, but to me, this looks like a leg in a trading range, and we could easily fall somewhere down here. Surprise bar 69, follow through 70, and then a small second leg up on 71. Whenever you get a big bull bar and then a weak follow through bar, it's really common to get a second leg that's 3 bars. So leg 1, pull back on 70, and then a breakout on 71. But because the follow through was weak on 70, traders scalp out. It's also at a new high, so another reason for traders to scalp out. So when you look at 68 through 71, it looks like leg 1 and what could be leg 2, but it's really a 2-legged pullback on a smaller time frame. Up, pulled back on this 1 bar, and then up again. for leg 2. 72, breakout pullback buy, high 1 in a triangle, probably going to fail. And then 73, a bear bar, and then everybody gave up on 74. 74 is a surprise, probably going lower, sell the close, or you can wait for follow through and sell. But the reality is, when you get that, and the market's been trying to go up in a channel for a lot of bars, and then you get this big bar closing far below the moving average at near obvious targets, 45 close, 38 close, 49 low. It's a sell the close bar, and we obviously sold off for the rest of the day pretty much. Big bar 74, smaller bar 75. It's kind of like this pattern over here. Whenever you get a big bear bar and then a smaller follow through bar, and then you get another big bear bar, you typically start to go sideways soon. Sell the close 74, sell the close 75, sell the close 76. But when you get a doji on 77 with a big tail, it's a warning that the market's probably going to go at least a little bit lower, but it may not go much lower. And then we went sideways into the close. For stop entries, I thought the best stop entry is probably buying above 16. So traders buy above 16, stop below 16. That's kind of the Walmart trade. But it's following a wedge, 1, 2, 3. So maybe a wedge, 1, 8, and 10, and then a failed breakout below the wedge. Or you can say the wedge is 1, 6, and 10, and then 16. But anyways, credible buy. And, you know, in this today, it led to several hours up. But it's reasonable buy above 16. I wouldn't do anything here. It's limit order trading. Maybe sell 13, but that's pretty aggressive. You know there's buyers below. And for a stop entry, if you're selling below 13, it's really difficult risk reward because you're selling, your stop's probably up here, and the downside's really limited. So I really wouldn't take that trade as a swing. Reasonable to buy 21, but that's kind of more or less the same as buying above 16. You can buy 28, stop below 28. Not ideal, but probably okay. And then it's probably okay to buy above 39, stop below 38, and you go for twice your risk. Buy above maybe 36, 46, stop below, go for twice your risk. But none of this is easy for stop entries. And, you know, Tim Stout, I think he said it in the Discord. I'm pretty sure he did. But he made the comment that a lot of traders, the reason why the part of this isn't easy is because a lot of traders are buying, they're catching a falling knife. They're buying as the market's falling to give themselves better risk reward. And I wouldn't sell anywhere in here. You know, you can sell 71, but it's really difficult. It's double top. You can sell it late in the day, betting on profit taking and a little bit of a sell-off, but to me, not that simple. For limit orders, almost the entire day was limit order trading. Bulls buying below bars, selling above bars, selling above here, selling the high of 9, buying below 12, buying 11, buying below 10. I thought the easiest limit order trades, probably buying below 17, or you can probably maybe buy below 29, a weak looking sell signal. But for most traders, I think they should wait for the downside breakout to fail and then look to buy. And then traders selling above bars, selling above 33, selling above any of these highs, buying below any of these highs, buying below 54, 55, 56, selling above anywhere up here, but hard to do. And buy the close, sell the close. Not really good buy the close, sell the close in here. Maybe sell the close 15, but remember what I said, it's 2 legs up, leg 1, pull back, leg 2. And whenever you get a strong breakout and you look to the left and you're right at the lows of that breakout, there's often buyers not far below. So for me, if you're selling 15, it's a scalp, which means you have to exit pretty quick. And I would certainly exit as the bar started to turn up. So if I sold 15 and the bar went down, you know, basically a measured move, of the bar itself, or maybe almost a measured move, and started to turn up, I'd be really quick to exit. Buy the close, maybe 23, but difficult to manage. You're buying high in a trading range. So for me, if you do that, you get out below 24, or your stop is all the way down here, and you really need to be able to buy more down here. Buy the close in here, maybe, but not ideal. And some traders will buy the close at 38, betting that the bears need one more bar. And obviously 39 was not a one more bar. And, you know, through here, tight channel, bulls buying bear bars, bears selling bull bars. I thought the easiest buy the close was probably the end of the day. Buy the close, sell the close was probably the end of the day, selling 74, 75, 76. Let me review questions one more time. But tomorrow, probably more sideways trading overall. Someone asked, how would I scale into this type of a sell-off? I think it's difficult because it's late in the day. And, you know, whenever you get a strong, basically a tight channel that reverses pretty quick and it's late in the day, it's typically going to evolve into a trading range. So the window to sell is rather brief. If you're selling the close 74, 75, it's probably not going to last all that much longer. So it's not really ideal. But for me, if I'm selling, I'm really just selling. You sell the close, probably stop up here, and, you know, you could sell again or just stay short, stop maybe 3 or 4 points above the bar or a couple points. But to me, this is a climactic sell-off, and there's a greater risk of reversal. Whenever you get a big bar, it's a sell climax. It's more climactic, which means there will be more profit taking below the bar. Someone asked, Brad, what do you think of bar 28? It was acting as support at the end of the day. Let's look at 28. Yeah, 28 is, there's a few ways you can look at it. 27 is a low one short, and traders sell it. They're disappointed. Some of them get out. Others, you know, maybe an institution, they just sell below 27 and they say, yeah, it's probably the start. You know, it's either going to go down or be the start of a channel. So they sell more higher, or maybe they sell in pieces on the way up. And what are they going to do at their original entry? They're going to buy back shorts. The bulls, they'll look at this sell-off and they'll say, yeah, 27 was a terrible place to sell. It immediately reversed up. The market has memory. Therefore, I'm going to buy at the exact same spot, and the market reverses up. And also, 28 is a higher low. You know there's going to be bulls buying below higher lows and scaling in, betting they can make a profit. Another person asked, Brad, in context of think like an institution, quote unquote, if they use only line charts to trade, then why are we doing bar by bar analysis? Yeah, so, you know, I use the term, let's take that in two pieces, because this person's asking actually a great question. What they're asking is, what does think like an institution mean? And if institutions are using line charts, why are we using candlesticks? Two things with that. Think like an institution, to me, means think big picture. You know, what is, I want to pull up a chart. So the first thing I think about is, you know, let's just do this the legitimate way. There you go. Obviously, you can see it's a 30-minute chart, but pretend this is, you don't know what the time frame is. I know you can see it up there, but ignore it. And I try and do this all the time and just look at price action. So I'm going to go to like a crazy number of 217. You know, who cares what the minutes are? And we're in a tight trading range. So what are institutions doing? What are traders doing? It's consecutive sell climaxes, so maybe a couple legs up, but the channel down is fairly tight. Now the market's going sideways, so you're getting buying pressure. There's probably buyers below bars, scaling in lower. This is a big bar, So I know bulls are disappointed, and I know some bulls bought here, scaled in lower. So this might be 3 pushes up, some bulls selling, bears shorting, but this is a strong enough rally for a second leg. Big bull bar follow through, but wait a second. We've talked a lot about second leg traps recently, and this might be a second leg trap. Second legs, I know that they test near the lows of the breakout, but they often don't go far below it. So what do? Maybe look to exit here, wait for 2 legs down, and look to buy. But anyways, the point of your question is, think like an institution is more or less, stop thinking from the lens of, when I'm thinking like an institution, I don't want to think about my own personal situation. I want to be Al, I forget the Ask Al video, but he talked about, the music of the market. He wants to follow the music of the market and ride the waves of the market. And what that means is he wants to do the right thing. He's more interested in being in tune with the market more than trading the way he wants to trade. So the second piece with line charts is the reason, you can look at line charts. Sell off, second leg down, tight bear channel, trend line break, probably a strong enough rally that there's probably buyers somewhere below, maybe a strong enough sell off for a second leg down. A lot of overlap. So we have a trading range in this box, probably sellers above. This is a strong enough rally that there's probably buyers on the way down. You can do that. And, if you think about it, I've heard Al say this. I can't prove it because, A, I'm not a hedge fund manager, and I don't know a ton of hedge fund managers, but it makes sense. I do believe that there's most of the money managers and institutions and hedge fund managers do not know a fraction of what Al understands. And they don't care to know it, because if you think about it, a lot of institutions, their goal is to make 10% a year. I think if you look online, I think the average fund manager makes about 10% as far as a return. That's the average, benchmark. Therefore, they don't need to be significantly better than average. They just need to be good enough to keep their job. And that's not a dig on anybody that's a hedge fund manager or money manager. I'm just talking about the overall market as a whole. You're not going to see institutions trying to swing for the fences because they don't need to. There's no point behind it. And there's a couple ways you can think about it. If you have a true fund manager for Vanguard or any of the major funds, they're not looking at a 5-minute chart. They're looking at monthly charts. And, here, sure, maybe they're looking at line charts. But the way they see it is, we've had a strong rally. I'm going to buy in, 10% increments on the way down, 15% increments. You've heard Al said it a lot recently, as far as if you want the easiest strategy where you can make money tomorrow, just start buying the S&P and scaling in, at 10% intervals. That's just, I'm quoting what he was saying. But as far as the line charts go, and to kind of add to the point behind making that question, think like an institution means focus more on the bars and less on the actual time frame. So for me, it's, I don't want to, I want to sell, but I want to make X dollars today. Therefore, I'm going to do something that's probably deviating from what I should do on this chart. It was one of the great, one thing I did a long time ago, but it was one of the greatest kind of, psychological things. I got on Simulated, and I picked an account balance, pick a number that's large, and where you can basically trade several E-mini contracts. And what I would do is I picked something where risking, 0.5% would be like a really big number for that day. And what was interesting to show me was, obviously it wasn't real, but the point behind it was I did not care so much about what I was doing. I didn't care if I had a full position on, because I knew that in like one trade or two trades, it was a good bit of money. And that's how institutions think. They think about the task at hand more so than being caught up in, trading a full-size position. The longer you trade, another piece with that, the longer you trade, the more you realize that it's actually kind of dumb to enter a position all in one lot. I mean, traders do that, but I believe a lot of traders that will do that, they'll be pretty quick to scalp out of some portion so they can add on later. So that's why being able to trade small and use wide stops and be flexible with positions is really advantageous. Let me check on the last bits of questions here. And to tie in this person's question, I know I answered it, but this person was asking about how do they stop being so emotional with their losses. They're trading small enough to where they don't care, but they're still struggling with caring, because obviously losing money time after time isn't fun. And that is just, again, practice thinking like an institution, and it just takes a long time. But the good news about trading is the longer you trade, eventually it becomes easier and easier to do the right thing, look at charts and, do the right thing, so to speak. But that just takes a lot of time. Okay, so that is all the time I have for today. I hope everyone enjoyed the webinar, and I will talk to everybody soon. Thanks for listening.